Good morning, everybody. Welcome back to day 2 of the MFS Virtual Summer School. Today, we're very happy to have Wenxin from the University of Chicago. Wenxin is a friend of the Macrofinance Society. She's now one of our board members and has been deeply involved with the group. She does research in the area of international finance, financial intermediation, and a lot of issues related to policy. And she's going to talk to us today about some of those issues. The title of her talk is Central Banking and Constrained Financial Intermediaries. I will just remind you sort of the rules. We'll take pauses for questions every couple of slides or so. And at that point, you're welcome to use the raise hand feature, and I'll call on you to ask your question. You can also type your question in the chat, and I'll ask Wenxin directly. And so those are the ground rules. With that, Wenxin, floor is yours. Take it away.
Great. Thanks so much, Alexi, for the introduction and for inviting me. I'm very excited today to share some research with you. So let me first start by sharing my screen. And again, as Alexi said, please feel free to ask any questions at any time. All right, so today's title is Central Banking and Constrained Financial Intermediaries. So I'm currently at the New York Fed. The usual Fed disclaimer applies. Obviously, everything I say today is purely my own personal view, and all errors are also on my own. Okay, so let's get started. First, give you a 4-bullet introduction slides. So we know that since the global financial crisis, many major central banks around the world launched the so-called quantitative easing programs and significantly ramped up the size of their balance sheets. So if you're still reading the intermediate or even advanced macro textbook from the 90s or from the early 2000s, the lessons that were presented in those textbooks might actually need a significant update. So this is what I put in here. The Monetary Policy 101 has actually been rewritten as a result of these large unconventional monetary policy programs. So that's very important to keep in mind. In the meanwhile, on the regulatory policy front, what we had is the Basel III, which is this global new round of banking regulation supervision framework. And in addition, in the US, we have the Dodd-Frank Act. So these important regulatory reforms arguably have also significantly changed the balance sheet constraint and all types of internal calculations facing large global banks and, more generally speaking, financial intermediaries in general. Okay, so what we have that's very different is both on the monetary policy front and also on the regulatory policy front. What I want to sort of bring up as a big picture message out of today's lecture is there's going to be a lot of connection between the financial intermediation, frictions and constraint, and monetary policy in terms of both implementation and transmission of monetary policy, and also more generally in terms of financial stability. So in particular, we're going to cover some prominent arbitrage opportunities that emerged only after the global financial crisis, in part due to the constraints on the intermediate balance sheets. So think about, we have these textbook no arbitrage. If you follow textbook, you think there's going to be a whole line of arbitrageurs that line up so that these arbitrage opportunities can be exploited, and they will no longer be there just after a short period of time. But because if you think about these intermediaries are become much more constrained because of new regulation post-crisis, then there will not be enough people lining up to exploit these arbitrage, and therefore the arbitrage can persist in this post-crisis environment. So we began to have a collection of very interesting near arbitrage or arbitrage, and these are the wedges. Think about the difference into rates, difference into spreads. And these wedges turn out to be quite important because, again, they affect monetary policy implementation and transmission. Okay, so that's the introduction. So let's move on to the outline. I'm going to cover 3 types of arbitrages today. If time allows, we can maybe have more open-ended discussion. You may have questions for other type of arbitrage. I may have some knowledge. If so, we can also have a more open-ended discussion in the end. But the plan is to first go over the first one called IOER arbitrage. This is quite related to Monetary Policy 101 in this new updated version. So we'll spend some time going through that. The second one is very much core to my recent research over the past few years, focusing on the so-called covered interest rate parity deviation, and therefore there is a CIP arbitrage. And what is the monetary policy connection to CIP? As we will see, understanding CIP has an important implication to understand the international or the external transmission of US monetary policy, because the CIP deviations reflect the offshore dollar funding condition. And finally, I'm going to be covering a different type of arbitrage. This one isn't like a pure arbitrage, but a near arbitrage. But it's also quite interesting. This is the difference between the interest rate swap rate, say either indexed to LIBOR or IS, with the US Treasury yield. So this is known as the swap spread. And what we have as a puzzle or as an arbitrage opportunity post-GFC is that the swap spread has switched sign from being positive to being negative in this post-GFC environment. And the question is, what does the negative swap spread have to say about the underlying functioning or the convenience or the inconvenience of the US Treasury securities, which obviously is also very much related to the monetary policy objectives. Okay. So that's the outline. And if there are no big picture questions, I will move on. Okay, I think we're good on question fronts. So now let's start with part 1 of the summer school. I think we get a break, right? After maybe like an hour and a half or something like that.
Yeah, we'll do a break around then.
Okay, so maybe we'll do like a break when we like almost done with part 2. But yeah, let's go through part 1 at least before the break. Okay, so this is IOER arbitrage, and the subtitle is Rewriting Monetary Policy 101. So what is the target rate for the Fed? I guess most people in this audience would say it is the federal funds rate. Okay, so the next question is, how is the federal fund rate determined? As an economist, your instinct would be it is determined by supply and demand, right? Okay, so that's question number 2. I'm just doing the self-asking and answering it because we're not in a live room. Then the third question is, how does the supply and demand curve look like for the federal fund rate? This is, I think, where the textbook was actually quite helpful, because you might remember a picture like this. Okay, so this is the classical Fed funds determination picture. I think this is maybe the so-called Poole's model. And the supply curve is very straightforward. The supply curve is exogenously decided by the Fed, because Fed controls the overall supply, at least in the classical world. I mean, more recently, there is this additional so-called overnight reverse repo facility that makes the overall supply of reserves not directly controlled by the Fed. But for the large part, I would say until very recently, it's always the case. Fed can pretty much decide on the total reserve supply. That's why the supply curve is vertical, regardless of the rate. So this is the usual price quantity chart where you have the Fed funds rate as the price on the vertical axis, and you have the quantity, the amount of reserves on the horizontal axis. Okay, so that's the supply curve. What is the demand curve? Demand curve in this case is usual downward sloping. So why do banks demand reserves in the first place? So prior to the GFC, what we have is that there is a deposit reserve requirements. So banks need to make sure that they have enough reserves given their deposit base. And each day, some banks might be over a bit, other banks might be under a bit. And you don't get paid if you're keeping extra beyond the usual requirements, and therefore no one has strong incentives to keep an extra. But if you do have a deficit, you're going to need to make sure that you borrow at the ongoing Fed funds rates to make sure that you satisfy the reserve requirements. So what we end up having is a downward sloping demand curve for reserves. And as you can see, the rate will not go above the so-called primary credit rate, because this is the rate that as a bank I can borrow from the Fed. So there's no reason to borrow other than the usual stigma and moral suasion. But if you abstract from those frictions, there's no reason to borrow from private market at a higher rate above the primary credit rate. And therefore, the demand curve is capped at this primary credit rate, okay? And if the rate is very, very low or close to zero, like we used to think there is an infinite demand for reserves, okay? And how is the Fed funds rate determined? So each day, people working in monetary affairs at the Federal Reserve Board, in talking with the people at the desk in New York, they basically forecast the demand curve for the federal fund markets, given the market conditions and giving some particular issues such as the Treasury coupon settlement, such as the GSE cash, etc. So every day they will have a forecast, and then they will determine what is the rate, what is the amount of supply through open market operations. So they can shift this vertical supply curve to the left or to the right to achieve their target federal funds rates. Okay, so that's the usual world. The Fed funds rate is determined by supply and demand. So what's different post-crisis? What's different post-crisis, in short, is that the supply curve has been shifted to somewhere that you can no longer see to the right of the screen. Why? Because the Fed balance sheet has expanded dramatically. So this is taken from the most recent monetary policy report, a semi-annual publication. This is the one that the chair of the Fed brings to the congressional testimony. So what you see here is this plots the Federal Reserve's balance sheet. So what are the main asset items of the Federal Reserve? What you have is a light blue area in the positive territory, that is the Treasury securities held outright. This is the Fed's holdings of Treasury securities. And then you have a darker blue, which is the Fed's holdings of agency and mortgage-backed securities. So what you see that's very, very distinct post-GFC is both the light blue and the dark blues have expanded tremendously, and that is the QE. So Fed increases its holdings of MBS and Treasury securities big time. And Fed, as any other bank, need to finance its asset holdings. And how is that asset holding financed? Through its liability items. So there's three main liability items being plotted here. The dark gray is the usual thing, which is the currency. This is the bank notes in circulation. So this is cash. So despite all this progress we have made in digital payment, this dark gray is actually steadily growing at almost exogenous rate, pretty, I think, on par with the GDP growth. So this area is expanding, so that helps, right, financing sort of a steadily growing Fed balance sheet, even if you don't change any other liability or financing options. However, like the growth rate of currency in circulation obviously is much slower than this tremendous growth of the QE program. So therefore, the Fed has to have additional way to finance its QE, and a big part of it is through deposits of depository institution, and this light blue is what we call bank reserves. So reserves are the banking sector's assets, but it's the Federal Reserve's liability. Reserves are created because the Fed needs to finance its asset purchase program. In the absence of an asset purchase program prior to the GFC, there was no need to have a lot of reserves. Now you have a large financing needs, and therefore you have to create a lot of bank reserves. Okay, so that's where the reserve comes from. What you see very interestingly in this chart is that in recent year, there's also a big expansion of this black thing. And in this monetary policy report, it is labeled as capital and other liability. If you actually read the long footnote here, so this item refers to some key components. One is the US Treasury General Account. So if you think about the light blue is the commercial bank's checking account balance at the Fed. The black line can include the US Treasury Department's checking account balance at the Fed. So Fed is the banker of all banks. It's also the only banker of US Treasury post GFC. And you might remember at the peak of the COVID response, there was a big lag between Treasury issuance and all these fiscal program payouts. And therefore, the Treasury actually accumulated, like, I think once over like $1.5 trillion of excess cash balance at the Federal Reserve. And it was then later spent down. Okay, so fluctuation in the Treasury's general checking account is also an important drivers of more recently the reserve behavior and also the overall composition of the Federal Reserve liability. So Treasury TJ account is important. In the past 2 years, another even more important item is the so-called overnight reverse repo facility. This is other non-banks checking account balance at the Fed. This facility did not exist until 2014, which we'll go into some details later on why, like the rationale to create such facility. But now it's becoming very, very important. And if you Google like Fed right now, like I don't know the exact number, I think it's probably close to $2 trillion parked at the overnight reverse repo facility. These are the lenders, which are non-banks and not US Treasury. So they do not have access to the light blue because they're not depository institutions. They cannot have reserve account at the Fed, and they're not US Treasury, but they are like these eligible non-banks that can essentially park money at the Fed in the form of reverse repo, meaning that the Fed is actually pledging collateral and the lenders are giving Fed the cash and they're earning the interest on this overnight reverse repo facility. Okay, so these non-reserve component has becoming quite significant in recent years. But big picture wise, right, compared to the pre-crisis level, where you can barely see any blue, right, light blue in terms of liability, the total supply of reserve in the whole system is just at a completely different level. And that is essentially showing here. So this is taken from Fed, where we plot the total amount of bank reserves in the whole system, beginning in the 80s all the way to today. I think prior to the global financial crisis, what we had in this first chart, like 15 billion may not be too off for an average day. But what is the number right now? I mean, it has coming down because of this uptake in the overnight reverse repo facility, but it once reached like $4.3 trillion. Okay, so it's a completely different environment that we live in today compared to the GFC. All right, taking a natural pause. There are no questions. Now the next important question is, okay, so we understood the classical supply and demand in the reserve markets. We understand because of QE, the total supply of reserve has exploded. The natural question is, what should the Fed do? What should the policymakers do if we want to increase rates to a positive level, like what we are doing right now, and like what we had down like in the previous rate hike cycle between 2017 and 2019 at least. So what can we do if we don't want to shrink the reserve level back to zero? Because if you follow this supply demand, right, it seems like if the rates is at zero lower bound here, and if I want to raise the rates, it seems like the only way is to shrink reserve, but that means actually run off or actually begin sales of treasury securities and MBS, which may not be optimal given the market conditions and the monetary policy objectives. So we have come up with a workaround. And the workaround is to start introducing one administered rate. So I'm going to talk about two later, but let's start first with one, is to start paying interest on reserves. Okay, so, and this is known as the interest on excess reserve, sometimes known as interest on reserve, because right now the amount of reserves and excess reserves are actually pretty similar, and one can also argue the reserves are not really excess because there are a lot of other demand for reserve beyond the usual deposit reserve requirements. So anyways, so we have this interest paid on reserves, and if you begin to pay interest on reserves, even though the total amount of reserve in the system is over $2 trillion, the main idea is once we set this administered rate, so each FOMC meeting, the Fed can decide where the IOER rate is. This is going to be the rate that the banks get on their extra checking account balance at the Fed. This rate by design should be a floor, right? A floor conceptually of all the money market rates, because this rates represents the best liquidity and the best safety. Why is it the best liquidity? Because this is the interest that you get on reserves. What are reserves? Reserves are literally cash, and they can be used to settle transactions. So this is the perfect instantaneous liquidity, and you actually get interest rates. And why is it the best safety? This is the rate that is promised by the Federal Reserve. Like the Fed controls the money supply, and there's no reason to suspect that the Fed would default. This is even different from the US Treasury bill, okay? So that is the idea. So if we want to raise rates, let's set the interest on reserve as the administered rate, so we can change however we want. And we believe as economists that this rate, because of its intrinsic attributes of being the safest and most liquid rate, should be the lowest rate, and all the money market rates should follow, okay? So that was the good idea. So what happened in practice? So the IOER was introduced soon after the global financial crisis. And when we began to raise rates, first time, actually even before raising rates, the IOER was in place. And where did the private money market rates trade? Interestingly, most of the private money market rates, regardless of whether they are secured or unsecured, traded below IOER as opposed to above IOER, okay? So this is the first instinct, I would say, where you might appreciate the importance of understanding the frictions and the plumbing of the financial system. Because as we discussed and motivated in the previous slides, this rate should be the lowest, but how come it is the highest? So what we have on this plot is we have the Eurodollar and we have the Fed funds. The Fed funds is the interbank rates for reserves, and the Eurodollar, if you like, just to think about it, is the offshore cousin of the Fed funds rates. So again, overnight unsecured, but largely traded offshore, whereas the Fed funds rates is the onshore rate traded inside the United States. And in addition, we have the Treasury GCF repo. This is the overnight repo rate with the US Treasury being the collateral. It is GCF. This is the specific segments of the Treasury repo rate where it tends to be the highest. There is another version for some of you working in money markets might know, that's called the tri-party repo rate. So what happens in practice is that the large banks are able to borrow from money market funds in the tri-party market at a very attractive rates, lower rates, and be able to lend to smaller dealers and the smaller banks in the GCF markets at a higher rate. So despite the fact that this black line represents, I would say, almost the upper end of the full distribution of the Treasury repo rates, it can pretty much fall below the IOER most of the time before we lifted rates. Okay, so enough suspense, right? Something must be going on so that all these private rates are below, and maybe it's even more striking for you to think about the Eurodollar and the Fed funds trade below IOER because these two are unsecured. So we're talking about the unsecured lending to like a random bank, and that interest rate is lower than the interest rate promised by the Fed. Okay, and
we do have a question. I don't know if this is the best time for it, but before
yes, that's definitely a good time. Yeah, I've been talking too much. Please.
Yeah, before we do the big reveal. It's about the reverse repo facility. Amy, do you want to ask your question live on the air, or should I?
Sure. Can you hear me?
Yes.
Yes, I hear you perfectly.
Cool. Thank you. So I was just wondering, like the reverse repo facility, is it actually used to fund asset purchases, or is it more of a like technical thing to like help some market makers and financial institutions? Because like my understanding was that it was not like it was intended to kind of like facilitate like market making in crisis times and stuff like that.
Yeah, so we'll discuss the overnight RP shortly. So my understanding, again, all takes in this talk are personal, is it was designed for monetary policy implementation purpose to make sure we have a floor, okay? So in this case, on this slides, we only have a ceiling, right? But if we want to make sure when we raise rates, we meaning the Fed, there's going to be an efficient pass-through into all the other private money market segments, we have to introduce the overnight RP as a floor. Okay, so
Thank
that
you.
is my
That's very
take.
clear.
Yeah, so in this case, that was a good segue. We'll discuss first why this happened, and then we'll discuss alternatives to fix it. The issue is this current setup. So overnight RP, was not introduced back then, and IOER was the only administered rate for quite several years. And then the concern is, okay, so if we raise the overnight IOER without the overnight RP, I mean, it's possible the private money market rates like repo and the Fed funds Eurodollar will just still be stuck at a pretty low level. And then that is very problematic, right? Because the Federal Reserve's objective is to ensure that the Fed funds rate, which is still the monetary policy target rate, stays within the FOMC announced committee range. So if you cannot achieve that goal, like you're failing your job. So that is not allowed. Okay, so before going to this alternative, adding overnight RP to the picture, let's first discuss this a bit wordy slides is like, why do private money market rates trade below IOER? Okay, so in short, in order to understand why does this happen, we have to first understand just in reality, the money markets are very segmented in the US dollar space, pretty much in every single country. But yeah, speaking context specifics, they're very much segmented in the US. In particular, there is one extreme type of segmentation. We have a lot of cash-rich lenders, such as the federal home loan banks, which participate in the Fed funds markets, but they are not depository institutions, so they do not have access to the IOER. IOERs are only paid to depository institutions. Basically, only these commercial banks have reserve accounts at the Fed. The FHLBs are not depository institutions and therefore do not have a reserve accounts. So think about in the ZLB environment, the IOER was set to like 25 basis points. These cash-rich lenders, these FHLBs, are willing to lend at a rate above zero, even though that rate is below 25 bips. So if bank is offered to essentially take your deposits at 13 basis points, you don't have really a good choice because you do not have access to that better option, which is only available to banks at 25. So you might just be settled at like 13 or 20 basis points, 12 basis points, okay? And naturally, if this is the starting point, if there is some money market segmentation, again, putting on your economist hat, you're gonna say there has to be a corresponding arbitrage. And you're absolutely right. And this is what we are going to cover. The first arbitrage, this is called the IOER arbitrage. This is the arbitrage where banks literally borrow at the lower rates from the private money markets, either from the FHLBs in the Fed funds markets or from the money market funds in the Eurodollar markets, and then park the dollar at the Fed. This is as simple as that. It doesn't involve knowledge of anything sophisticated. It's really just like a money dealing business. I'm going to source funding at a lower rate, and I'm going to park the money at the Fed, which is the most liquid and the safest option I can ever get. And the most remarkable thing about this is I earn a positive spread by doing so. All right, so that's understood at this point, but then it still sounds a little weird, isn't it, right? Because there shouldn't be any free lunch, but what I just described is indeed like the ultimate free lunch, and it's just very, very low tech, right? Why can't everybody do that? Like everybody meaning the banks with reserve account at the Fed. So it turned out, this is where the second bullet from introduction came to bite you. Banks cannot do that, at least not to like a large or infinite scales to beat up the Fed funds rates, because the IOER arbitrage expands the size of bank balance sheets. And having a large balance sheet is costly from regulatory perspective. In particular, it makes the non-risk weighted leverage ratio constraint more binding. Okay, so a lot of jargons. So what is a non-risk weighted leverage ratio requirements? So if we think about bank capital regulation, what you have in mind, which goes back to Basel III or even earlier, is a risk-weighted capital regulation. So historically, banks have to maintain, are required to maintain a high amount of capital if they have a riskier asset composition, right? What makes like things completely different under Basel III is that under Basel III, with this global coordination, it codified a non-risk-weighted leverage ratio requirements, which requires large global banks to maintain at least 3% capital against all assets regardless of their risk characteristics. This means by putting on a trade like IOER, even though it's completely riskless, it's completely risk-free, banks still need to put aside at least 3% capital against such a trade. And we know maintaining a capital is costly. So therefore, there is an opportunity cost associated with putting on $1 more of such trade. And banks cannot and just may not be willing or just do not have that amount of balance sheet allocated to that business line to engage more of these opportunities. Okay, so that's a very important consideration. And going back to the leverage ratio constraint, this was completely new for non-US banks. Prior to Basel III, there was no non-risk weighted capital requirements for non-US banks. So it went from 0% essentially to 3% for non-US banks. For US banks, historically, there was actually a total leverage constraint at 3%, calculated in a more accommodating way. What makes difference is that post-crisis, we have the so-called US implementation of leverage ratio constraint in the form of supplementary leverage ratio, which beef up the 3% to 5 to 6%, and also calculated in a more rigorous way, including off-balance sheet exposure and repo and a bunch of other stuff. So for everybody, the leverage constraint became much tighter post-GFC. So the leverage constraint in this context is certainly very important. It is not the only dimension that is limiting the amount of IOER arbitrage. In addition to the leverage constraint, there is additional fee which is involved for US banks if they put on $1 more of IOER arbitrage, and that is the FDIC deposit insurance fee. So after rule change in 2011, the FDIC assessed X% of fees on the total asset base of commercial banks if the subsidiaries and branches are FDIC insured. So for US banks, thinking about sourcing like more Fed funds from the FHLBs, it's going to be booked at the commercial banks, and there's going to be another, say, 5 to 6 basis points FDIC insurance fee. So that would erode the amount of profits associated with this IOER arbitrage. But interestingly, foreign branches in the United States, they're pretty large. There's public data on the amount of activities through the weekly reports published by the Fed. So they're pretty active, and they do not pay the FDIC insurance fee. And therefore, naturally, and also, as we discussed, they face a lower total leverage requirements because for them it's 3% versus for US banks it's 5 to 6%. So it may not surprise you, and I will show you a plot later, is that the foreign banks actually account for the bulk of the IOER arbitrage activities. Okay, so if we're good on the slides, that is the verbal explanation for why private money market rate trade below IOER. The short answer is, first, we start with money market segmentation. So lenders are willing to lend at a rate below IOER because they do not have access to IOER. And on the flip side, the limits to arbitrage is the banks that are able to do the arbitrage are facing balance sheet constraint due to the leverage ratio requirements. And the US banks also face additional FDIC insurance fee.
Wenxin, can you say just a little bit more about these federal home loan banks? They seem pretty important. And it's not a set of institutions we hear much about. So where does that cash come from?
Right.
What is the role it's playing?
Right, exactly. So here I'm singling out the federal home loan banks because they are this particular type of market participants in the federal funds markets. But more generally, you can also think about in this whole money market landscapes, we have a lot of money market funds, which are non-banks, which also naturally have a lot of cash to manage and do not have access to the IOER. So basically, there is not just the federal home loan banks, there are just a bunch of non-banks with a lot of cash for whatever institutional reasons. So if you're interested in the federal home loan banks, I think if you do like a literature review, there are a couple of very interesting papers coming from the Fed and also I think coming from researchers at Columbia that look at their roles and discuss their roles very specifically. And in particular, so they also serve the role of essentially providing a better liquidity profile for banks. So the US banks in particular, instead of borrow from the unsecured wholesale markets, we also see them borrow from the Federal Home Loan Banks in the form of FHLB advances, which have better LCR treatment. LCR meaning liquidity coverage ratio, which is another important pillar for Basel III than the usual financial borrowing. So they're quite interesting and they're quite important, but they're not the only one that is causing this this segmentation.
Gotcha. Are there any other questions right now? And you want to raise hand or type anything in the chat? Feel free. Okay.
Okay. All right. Okay. Now let's go ahead. So this was the discussion for why this happens, and as we already speculated, there should be a lot more active participation by foreign banks than U.S. banks, and is that the case? And so I have a recent working paper. This is joint with former colleagues at the Federal Reserve Board, where we have access to a very detailed data, both transaction and also position of various wholesale funding money markets. And we can construct these proxies. Like no one is going to file a transaction labeled as IOER arbitrage, so you're going to have to come up with some proxy. And this is the number we came up with. So the proxy we have in terms of the IOER arbitrage position for US banks, which is shown in the blue line here, is fairly small in comparison to the numbers for foreign banks, which is shown in the red line. So we're talking about roughly about $50 billion for US banks on an ongoing basis for a big part of the post-GFC sample. The reason that I have a big vertical line on this chart is the focus of the paper was to study a very important money market reform back in 2016 by the SEC. We can discuss more about this reform if time allows later, which is an important event in the money market, and it's related to a lot of stuff we discussed today. And for foreign banks, as you can see, the numbers are significantly larger, maybe on average to about $350 billion before and after the money market fund reforms. So that supports the conjecture. This activity is pretty much dominated by foreign banks. And then if you think about it, what is the Fed funds market in this post-crisis environment? I'm not talking about every day, but for most of the days, it is a very strange market, even though this is the market where the Fed actually looks upon for its monetary policy target. This is literally a market where the foreign banks borrow from the FHLBs to arbitrage the spreads between IOER and the Fed funds rates. Okay, so this is not the market, no longer the markets where banks borrow from each other in order to satisfy their required reserve requirements on a daily basis. So the nature of the Fed funds market has been transformed completely. And this is, in a sense, the monetary policy 101 has been rewritten. Okay, and you might be very curious about what happened on these downward spike days, right? Like we have this massive shrink, say from like close to maybe $500 billion all the way down to $200 billion. And that is very interesting phenomena, which will come up when we go through the CIP related exercise. This is the quarter end window dressing. And why do banks, especially foreign banks, window dress their balance sheets by massively contract activities such as the IOER arbitrage? This happens because the leverage ratio calculation for many banks outside the US jurisdiction is based on the period end, or in particular quarter end snapshot. And if you want to have better reported leverage, or maybe you're actually a little over outside quarter end days, but want to make sure you stay out leverage ratio compliant, you have to massively shrink your balance sheet. And what are the business lines that you can actually shrink on the last day of the quarter and then immediately put back your activity the next day? It has to be something that is very scalable. And for IOER arbitrage, which is like an overnight, very liquid arbitrage, you can essentially do that. So that's why this type of activity is the first line to cut if you want to cut your balance sheet on quarter end in order to have better reported leverage. And that's indeed the case. Like you see a massive like 200 billion contraction, at least like this is a year end in 2015 year end. Okay, so then you might wonder, okay, maybe this is just too pronounced. It's hard to discuss this slide without discussing a little bit about the black line. So what happened after the money market fund reform? What happened after the money market fund reform? So first, let me tell you a little bit about the reform. So broadly speaking, there are two types of money market funds in the US, the prime funds and the government funds. Okay, so what is the prime fund? The prime fund is allowed to invest in any short-term debt securities with remaining maturity less than a year, regardless of the sector. So it can invest and also secured or unsecured. Okay, so it can lend to the government, meaning holding T-bills, or it can lend to a bank unsecured, meaning like holding like a bank CD or a CP. CD is certificate deposit and CP stands for commercial paper. Okay, so that's the prime funds. The government fund is only allowed to hold treasury securities or hold repos backed by treasury securities. So the government fund is allowed to lend to a bank, but only if the bank pledges treasury security as the collateral for that type of lending. Okay, so what the reform did in the 2016 is that it made the prime funds a lot less money-like, a lot less attractive compared to the government funds. Okay, so in a sense, the prime funds can impose gates and fees in the very stressful events and limit redemption, where the government funds still have to allow investors to redeem their money market shares at par on demand. And also, in addition, the prime funds are required to adopt the so-called floating net asset valuation as opposed to the historically stable net asset value. So in theory, $1 put in the prime funds can in theory become 99 cents tomorrow. So because of these features that made the prime funds a lot less money-like, there was a huge outflow, close to $1 trillion in terms of asset under management from prime funds into government funds. And as a result, remember, it's only the prime funds that are able to lend to banks in the unsecured private money markets. So that has led to a significant reduction to the total availability of unsecured fundings to the banking sector. And translated into our arbitrage discussion, this whole reform led to a significant contraction in the supply of arbitrage capital for banks. So that's why you see there is a big reduction in the IOER arbitrage position, because banks, which used to borrow a lot from money market funds to do these type of arbitrage, no longer have that ready sort of intermediaries to source funding. And as a result, they scale back their arbitrage significantly. And if they don't have as much of an arbitrage to begin with, then they don't shrink their balance sheets on quarter end nearly as much. Okay. So that was a rather extended discussion, which was pretty much the main gist from this working paper. Okay, so that was enough discussion on the IOER and why the IOER turned out to be a ceiling as opposed to a floor. Going back to the first one of the earlier Q&A is, so the mission is not accomplished yet for the Fed, right? So we still want to solve the problem to be able to convincingly raise interest rates in the environments with a lot of excess reserves, right? So we do not want to scale back our supply of reserve back to the pre-GFC, but we want to raise rates. And just having the IOER is not enough because that's a ceiling. We don't know where the private money market rates can print. So, but after understanding the plumbing and the reason why the IOER is the ceiling, I think everybody, most of us can come up with a solution, right? Is to offer an alternative administered rate that gives much broader access to market participants. Because access and segmentation was the problem for why IOER is so high relative to the private money market rates. But if we have this alternative deposit facility for the FHLBs, for the money market funds, then that would be the floor rate, because they wouldn't be willing to lend at a lower rate compared to what they can lend to the Fed. And that's exactly what happened. So the overnight RRP was introduced by me to the original JEP paper. But by that time, it was pretty clear that was absolutely needed if we want to ensure that the implementation stays within the committee's objective. And did it succeed? And the short answer is yes, I think to a large part. So this is a chart showing you the previous, not the current rate cycle, rate hike cycle. So beginning in the I think end of 20s, maybe 2015, end of 2016, 2016, the Fed initiated a series of rate hikes. So now in the environments with excess reserves, the job of the monetary affairs department is simpler. Previously, like if you talk to economists working in the money market analysis section, they would say they need to get into office like by 8 a.m. and then they will need to forecast the shape of reserve demand curves, and then they need to go back and forth with New York to decide on whether today's supply is 15 billion or 20 billion or 25 billion. But now their job is simpler because they do not need to forecast reserve demand. The reserve demand is going to be at whatever rates, like the reserve supply is like infinite relative to the shape of the reserve curve where it's downward sloping, at least for a large part of the post-crisis sample. And therefore, we don't need to forecast reserve demand. If we want to raise rates, what we can do is simply increase the IOER and the overnight RP and hope that the force of arbitrage will make sure that the private money market rates is going to trade in between the two rates. And if you go to the FOMC statements, like they don't target a single Fed funds rates, they target a range, right? They say we want the Fed funds rates to be in between, say, 0 to 25 basis points or 25 to 50 basis points. That's super convenient because all you need to do is to set the overnight RP to be the lower bound of this Fed fund target range and set the IOER to be the upper bound of the Fed funds target range. And then just by the force of arbitrage, the Fed funds, it's going to be guaranteed to trade in between if everything goes according to the plan. And yes, if you look at this previous rate cycle hike, and pretty much, so you change the IOER every single time by 50 basis points, and you also change the overnight RP by 50 basis points, but you are allowing a gap in between so that there is some rooms for the Fed funds rates to fluctuate. Okay, and we're going to discuss what's happening here, but for a large part of the post-GFC cycle, at least from this previous rate hike, I think I put 2017, but it's actually 2016 all the way to 2019. It's pretty successful, isn't it, right? The committee achieved this objective of raising interest rates without, I mean, yes, there was some balance sheet normalization later, beginning in 2017, but at least in the 2016, there was no balance sheet runoff at all. I see there are a couple of questions, so we take some questions now.
Yeah, we have a couple of questions. The first one, I think it's a little beyond the scope here, but what was the main reason why the Fed funds rate stayed so low after the GFC until 2015, despite the economy being stronger?
Oh yeah, so that is a bit beyond the scope of today's discussion. So we are the plumber today. Our goal is to implement the objective set forth by the committee. And yes, so obviously you can think about the Taylor rule, you can think about other reasons, like there's going to be a lot of deliberations inside the committee designing the path and the target range. But that's a bit beyond the scope of today's talk. But yeah, obviously very important question.
The second question, are there any conditions for a financial intermediary to be able to access the overnight reverse repo facility? So could a bank access it? I think is the question.
Cool. So if you look at this rate, you wouldn't want to access it as a bank, right? Because what you can get from the IOER is always higher than what you can get from the overnight RP. There's obviously an eligibility requirement for overnight RP. It's not everybody, like you and I, do not have access to the overnight RP directly. So yeah, I actually do not know the specific eligibility beyond the usual, like the large ones are certainly eligible. But yeah, you will need to look at the requirements on the Fed website, and I'm pretty sure it is public information.
Money market funds.
Yes, large money market funds. I do not think, I think every single money market funds has access though. I could be wrong. And another important thing is there used to be a cap, but now the cap was also lifted. There's still a cap, but the cap is much, much larger now. Yeah.
Do you know if money market funds pass that rate through pretty well? If I invest in a money market fund, am I going to get something pretty close? You know, their expense ratios are low.
Right. There's even beyond the expense, I don't think it's perfect pass through. This is talking from personal or retail investments in money market funds, they do not correspond nicely. But if you look at their holdings, especially today, I think more than 70% of the large ones, like the Vanguard Fidelity funds, are all in reverse repo, and the counterparty is the Fed. So it is a very important portion of their investment portfolio for the large ones, at least. But the pass-through is not 100%. It is quite correlated with the RRP as we demand higher return as the Fed increases their outside options, but it's not 100%.
Okay, we have a couple more. Let's see. Carlo, do you want to ask your question live? I think it's about the spikes.
Sure, I will. Thank you. I was just wondering, out of curiosity, why does the Fed fund fall so cyclically, although it remains between the two banks?
Good question. I was about to cover it before I took the natural pause for questions. This is very much related to the window dressing activities that we covered. Remember, there was a big contraction in arbitrage activities on quarter ends, right? And if you think about if there's less arbitrage, the arbitrage spreads should go up. And how can arbitrage spreads go up? The IOER is fixed. That must be the Fed funds rate has to be lower. Okay, so that is the first order intuition for why you have a lot of downward spikes, is because there was an increase in the arbitrage profits on days when the intermediaries are more constrained from doing the arbitrage. But that's not all, right? Because if you look very careful, this is not a quarter end downward spike. It is the month end downward spikes. And if anything, yes, you're right. Probably the quarter end spikes and especially the year end spikes might be, I think, statistically higher. But it's not that obvious. Like pretty much every month end, there was a big downward spike. So what else is going on? So it turned out that in several jurisdictions, not a lot. I could be wrong, but I believe I read in Netherlands, I'm just calling out Netherlands, but I could be wrong, where the leverage ratio is actually assessed based on the past 3 months end average. So therefore, month ends are also important for a small subset of foreign banks than on quarter ends. But in addition to balance sheet constraint, it's very possible there's also bargaining and imperfect competition going on, because the print of this Fed funds rate is essentially a profit split between the banks and the money market funds, and where the Fed funds prints reflects the bargaining power between banks and the money market funds. And one can argue that on these months and days, just spread credible is threatening a little bit, that banks are not going to be willing to borrow as much from money market funds. So because of these Dutch bank constraints, the overall banking sector is going to be able to capture a larger share of this profit. So that's my own personal interpretation for why the money market, why the Fed funds rates also go down on month ends to relatively to a similar magnitude compared to the quarter end, because the balance sheet constraint explanation alone is not sufficient to explain the similar magnitudes in a change, because we know the quarter ends are going to be much more constrained compared to the month ends, because that affects much more banks. The month ends only affects like a small subset of banks, but if the price behaviors are quite similar, there has to be some other frictions going on, and I just give you a story about like credibly threatening and then being able to get like a higher bargaining power story.
Let's see, a couple more. Charles, do you want to ask your question live?
Hi there. This might be a bit outfield as well, but I was just wondering if you have any opinions on whether would wholesale central bank digital currencies have any impact on the financial plumbing system that you described so far?
Yeah, so right. It's a very complicated question. So obviously has many dimensions. I would say, so in terms of a lot of issues, right? I mean, so first it would change the shape of the Fed balance sheet significantly on the liability side. Like we covered, the liability includes the bank notes, the liability includes banks checking account balance at the Fed and other non-banks checking account balance at the Fed, right? So what the CBDC, once that's introduced, that you're going to see most likely, maybe there's going to be a shrinkage of cash, even not disappearing, because there's still going to be some illicit, like illegal activities that use cash to settle, where like we don't think CBDC is sort of fully anonymous. But there might be some substitution from cash, and there might be some additional substitution from bank reserves, right? Depending on how the CBDC is introduced, but it's possible like individuals can hold accounts with the Fed, and therefore they don't hold their accounts with banks. So I think a lot of things can change, and really I think that depends on the details of the rollout. But there hasn't been sort of a specific narrative that's being put forth yet.
It seems like a really close substitute for the overnight reverse repo facility, right? Because it would be available to non-banks. So in a sense, I mean, like you said, it depends on exactly how you design it, but that one seems like a very clear substitute.
Yeah, so it's like a non-banks, UNR non-bank. It also depends on whether that's interest rate bearing or not, right? And then there's a cap. So I think it can't really fall in between. There's also a version that's being discussed, which is like a tokenized deposit version. So it's like banks are issuing these stable coins. It's not from the Fed. It's like my deposit is tokenized so that it can benefit from all these like smart contract blockchain stuff, like with Bank of America, with like allows for 24/7 instantaneous withdrawal, etc. So that version is going to be a lot more isomorphic to the current system. But if you actually have like a CBDC as like a brand new thing, as a potential completely new different liability item, yeah, I think a lot of the dynamics we discussed today need to be reworked.
Right.
And also it has significant implications on potentially on banks intermediation. But I think a classical debate that actually emerged way before the CBDC discussion, that's whether we need narrow banks. So if you go back to the discussion, like search for narrow banks, I think people, prominent academics like Darryl Duffy, and also the previous head of the research group at the New York Fed, Jamie McAndrews, both sit on the board of like, I think a very interesting case of the narrow banks. And what the narrow banks did is they would source deposit and literally put it in the form of bank reserves at the Fed if they are granted a reserve account. So you can think about that. The implication of that can be quite similar to implication of like a pure version of a CBDC. Yeah.
We have another question. Matthew, would you like to jump in and ask?
Sure. I was just going to ask if this floor system made it more difficult for the Fed to hit its inflation targets. I wrote a long question, but I'll just leave it at that. Yeah.
Oh, okay. So I guess it's a little hard to answer that. Again, I feel like it's still a little bit beyond the scope. If anything, maybe you're referring to the ONRP is like lower than this IOER, and for some reason, like you didn't raise rates as much as like maybe the Fed funds rate is implying or what the IOER is implying. So if that's the case, I guess there is a bit of that, but if anything, like you're not really constrained to how much you can raise, right? What we have seen so far is like 275 bips raise, and that is pretty high, right? In terms of the step that you can take. And I mean, you can move the corridor more aggressively, like either way. So I think the design itself is not really preventing you from accomplishing your target as long as you know like what is the objective, like what is the target range that you want to hit.
All right, we have one more question, and then we should probably move on. Pranav,
Okay.
you want to jump in?
Hi. So I wanted to ask whether this implies that monetary policy has become more dependent on non-chartered lenders, like the lenders that facilitate the arbitrage. And as their excess reserves reduce or their liquidity reduces, formal banks that have access to the IOER can do less arbitrage.
Sorry, I didn't follow the first part of the question. You're saying monetary policy is less dependent on
Is more dependent on non-chartered lenders, the money market.
Oh, you're a loan chartered lender.
Non-chartered.
Like non-bank.
Non-banks. Oh, I see. Monetary policy is more dependent on non-banks. I would say like, I think you have the right instinct in the sense the distinction between banks and non-banks in this context has become more pronounced because of the segmentation and also the lack of perfect arbitrage from the bank's part. So yes, I would say yes, the role of non-banks has becoming more important in this transmission and implementation of policy. Yes, I think I would agree with that as overall statements post GFC. But also, like as you can see, the role of banks are still crucial, right? Because it's going to be a constant theme across the three parts of today's lecture. They're the ones in the middle. Like despite the large growing of non-banks, I mean, if you think about like a supply demand side of this arbitrage story, the non-banks is oftentimes the demand side. And in terms of like what are the structural problems that makes the arbitrage to exist in the first place, that's in the sense of demand. And the banks is sort of supplying of arbitrage capital to limit that. So like how much banks can supply in terms of their balance sheet capacity is still going to pin down the equilibrium wedges of these types of these sort of things.
I see. Thank you.
Okay, great. Any other questions, Alexi?
That's it for now. Let's
Okay,
keep
great.
going.
All right. I'm glad we had a good discussion so that I'm just not just going through the slides. So we had a discussion about why you have these cyclical patterns, at least like when the Fed funds rate is in between, right? But you also see from this chart is as we get to the later half of the cycle, or like later a quarter of this previous rate hike cycle, this was between 2018 to 2019. Seems like things have changed in the sense that the Fed funds rate is no longer like very much in the middle or in between. It's pretty close to the upper range, and it can actually, if you squint at it, it can actually print above the IOER. So something else is going on, right? And when the Fed funds rate is very close to the IOER, this arbitrage will not be there anymore, right? Because banks still have balance sheet costs by putting up, and there's FDIC insurance fee. If the basis is like less than 10 basis points or maybe 5 basis points more strictly, it's just not a good trade anymore to put on. So something else is going on. And if you do remember, I don't know, I'm gonna make you feel dizzy by going back to the Federal Reserve balance sheets. Let's see if we can see it. This scale is so distorted by the COVID response, but what you had is actually between 2017 to 2019, if you see, the overall balance sheet was actually shrinking. So it was the first time that the Federal Reserve actually normalize its balance sheet post GFC through the process that we all know today, quantitative tightening, by allowing the balance sheet to run off, meaning that the Fed is not going to purchase securities when its existing portfolio matures. And that has translated to a significant reduction in reserves, as you can obviously notably see from those charts. So the overall light blue area in the liability has shrunk significantly between 2017 to 2019, right? So going back to this 101 chart, even though the scale is massive, very different, this is not 50 billion, you can still think about the same force as the Fed is contracting its reserve supply, despite we're not talking about contracting from 15 to 10 billion, we're talking about maybe contracting from like 2.8 billion to like 1.4 billion. So that difference is still going to put upward pressure on the Fed funds rates. And if it actually hits the segments of the demand curve that is downward sloping, then the rates can also go up just by the usual supply demand dynamics, as opposed to be guided by the administered rate corridor. Okay, so that's essentially what we believe, or what I believe personally, that has happened in this later half of the sample, is there was an overall reduction in the supply of reserves because the Fed was normalizing its balance sheet, and also we know the currency in circulation was always steadily growing, so the overall supply of reserve actually contract to their multi-year low at the end of 2019. And if you remember, there was a major hiccup in September 2019. The US repo market actually hit close to 10%. And soon after that event, the Fed reversed, even though I think the balance sheet normalization was already on hold before that event, but after the event, it was abundantly clear that there was not enough reserve in the system. We're no longer in the so-called ample reserve regime. Like it became like we all need to start like forecasting the shape of the reserve demand curve again. And if that's not desirable, we have to actually increase the size of balance sheet. And therefore, the Fed actually did like a mini QE. It wasn't called a QE because it wasn't at that time monetary policy accommodation was needed for like a real economic reason. It was put forth, I think, in the statements that they had to do a QE for technical reasons. In a sense, they had to create more reserves. So they purchased treasury bills and shorted coupon bonds, and also reestablished the repo facility. This is not the reverse repo, but the repo facility, which allows banks to borrow directly from the Fed as opposed from the dysfunctional private repo market. And that's another important way to restore the market functioning. Okay, so and then what happened afterwards? This chart was not up to date. We all know, like COVID hit, right? And then Fed did like a massive round of QE, so we were right back to the ample reserve requirements. Okay, so there's a very interesting working paper by New York Fed economists. It may not be easy to search because it's relatively new, but I think it's an interesting case because it tells you how do we know if we have enough reserve in the system. This becomes very hard to answer because reserves are also so different now, right? Previously, they didn't pay interest and there was no liquidity requirements. So reserves were there for banks to satisfy their deposit reserve requirements. It was very simple as that. But now reserves are very different because there is also intrinsic demand for them because they are considered level 1 high quality liquid assets. They can satisfy the liquidity coverage ratio under the Basel III, which is an important pillar in terms of liquidity regulation, not for capital regulation. And in addition, banks may want to prefer to hold a lot of reserves because it has much better intraday liquidity compared to lending out that cash overnight in the repo markets. So in order to understand all these intrinsic demand for reserve, which certainly has gone up in addition to the supply, it becomes quite difficult to forecast, right? Just conceptually, like where the demand curve starts like a downward sloping. So what nice thing about this paper is it gives you like a model, I think it gives you like a econometric model, but it's actually model free from quantitative sense. And the insights is the spreads between the IOER and Fed funds rates can deliver good jobs in forecasting whether we have ample reserves in a sense like we don't need to worry about where the slope is. And if you follow this logic and also the intuition I just outlined, it is pretty clear that even before we hit the September 2019 repo market spike, there was not enough reserve in the system. Okay, so
could it be, Wenxin, can I just ask real quick? Could it be that as the balance sheet shrank at least a little bit, it's sort of surprising that what doesn't look like a huge tapering would have brought us back to the downward sloping portion of the curve.
right.
So could it be that it made the SLR no longer bind? And then I don't know if in your data on the arbitrage activity you see that increasing. Because that would exactly, if they became unconstrained by the SLR, that would explain why it exactly nails it to the IOER. But I don't know if your data extends to that period.
Yeah, so I'm not aware of sort of the so what Alexei is having like alternative hypothesis, right? We know the spreads between the orange and the blue is the shadow cost on the leverage constraint, right? Because if there's no leverage constraint, abstracting from the fees, then this thing shouldn't exist in the first place. But now this thing is no longer there. Like, is it because there's no constraint on the, there's no shadow cost on the constraint, meaning the constraint is not binding? Not to my knowledge. So if anything, if you look at the timing of these things, it's really the most salient event in the global financial markets was the Fed balance sheet normalization and the shrinkage of reserves. I'm not aware of any particular notion that this is related to the LCR. Maybe the second part of the talk will help us to revisit that because we have the other arbitrage, which also affects the balance sheet constraints, and they're still pretty steady throughout that period. So yeah, so I personally don't think it's the LCR becomes slack. Sorry, now SLR, exactly. Yeah. Sorry for misspeaking all the time. Yeah, it's not the SLR becomes slack, but more importantly, I think is the shape of the reserve curve starts we're hitting the downward sloping portion. Okay.
Gotcha.
All right. So I think we accomplished our goal to covering the first segment of the lecture. So now I can take another natural pause quickly if there's any big picture questions on the monetary policy 101 or specific questions.
Anyone have a question? Feel free to ask. It'll be a good time.
Okay, looks like we're good for now, right? Okay. All right, perfect. Thanks for still paying attention. If you have seen like my other lectures on CIP, you can take a break for the next 40 minutes, but if not, I'm gonna go through them with you again, maybe with some additional insights this round, because every time I go through the material, it's a little different. But if you want to take a break, if you're already expert on CIP, because I've given a couple of talks, then you can take a break and then come back for the final part, which is new. Okay, so the next one is a different type of arbitrage. Now we're switching gear, and this portion, as a warning, requires knowledge of international finance and exchange rate, whereas the first portion did not. Right? It was all closed economy, it's all in dollar, and therefore the implication of this portion is also more international. Right, so think about as a monetary policy maker, I set the Fed funds rate. Now we understand it's not so simple, right? I mean, after going through all the first 13 slides, we understand now how the Fed funds rate is determined. And then the next question is about the monetary policy pass-through. The Fed funds rate is going to first immediately go to some short-term funding in the US dollar space, which, as we know, probably like even though that object has died, it was important for a long time, and that is the 3-month LIBOR, right? So even though LIBOR died, but the LIBOR equivalent in terms of concepts, in terms of commercial paper and certificate deposits are still there. And the next question is, how does it affect the offshore dollar funding conditions or these implied dollar interest rates in the foreign currency markets, and how does it work? So let's first look at a chart first, and I'll slowly explain what is going on. So, so essentially, there are two ways to borrow dollars. You can borrow directly, say if you're able to say find the money market funds, I'm gonna borrow from them as a bank, either term funding or like overnight funding. So think about overnight funding as being the Fed funds rates, and the term funding just proxied by the 3-month LIBOR rate. Okay, so the Fed funds rates in these charts is the gray thing, is the gray line, and the LIBOR, which is the term funding, which is the black line. Okay, so there's going to be some spread reflecting the term funding premium. Not a big surprise, both before crisis and after crisis, there's going to be a spread between the black line and the gray line. That's fine, that's usual, that's very well understood. Like the pass-through is not going to be 100% because of the fluctuation in the term premium between 3 months and the overnight interest rates. Okay, and that difference, that spread actually widened significantly during crisis because we think there was a lot of concern for banks' credit risk, and LIBOR at 3 months unsecured term funding. Very likely large banks might go under within 3 months during peak of the distress. So it's no surprise. Okay, so it's just a temporary market dislocation due to the fear of credit quality of the banking sector. It doesn't suggest anything sort of structurally different. But what's very different in this chart is that pre-crisis, you can barely see any colors, right? I mean, you basically see a gray and you see a black line. All the color lines are pretty much lying on top of the black lines, whereas post-crisis, you see a full spectrum, like a very colorful, like a full spectrum of interest rates. So what are these colorful lines? These are the implied dollar interest rates from the foreign exchange swap markets by borrowing in a particular local currency, say in the 3 months Euribor, and use 3 months FX swaps or forward to swap that euro funding into a synthetic dollar funding. Pre-crisis, the very, very important textbook no arbitrage called cover interest rate parity condition held. Therefore, the implied dollar interest rate from the euro dollar swap markets by borrowing Euribor swapping to LIBOR was exactly equal to the 3 months dollar LIBOR interest rates. That's why pre-crisis, you only see one black line in terms of 3 months term funding, whereas post-crisis, CIP no longer holds. There is going to be a persistent wedge between in this case, what is the color? Yeah, the green line and the black line. And the difference between these two rates, like the implied dollar interest rate from the euro dollar swap market and the direct dollar interest rates from dollar LIBOR. And that is what we call the CIP deviations or the cross currency basis. Okay, so that is the conceptual definition of these wedges. And why are these wedges important for monetary policy? because there is a lot of dollar is the global currency, right? I mean, there's a lot of market participants based in Europe, based in Japan that need dollars, but do not have direct access to dollar borrowing, right? The whole issue here is, again, a very high degree of money market segmentation. Like we have US money market funds that have a lot of cash, but they cannot lend to like a second tier Japanese bank. They cannot lend to like a Euro area, like life insurance company. It's in their mandates to only lend to the top tier global banks, right? So how do these second tier Japanese banks or like a Euro area insurance company get the dollar funding or hedging services? They have to go through banks. And again, the constraints on the bank's balance sheet is going to affect the cost of the synthetic borrowing by these residual players who do not have access to direct cash market funding. And naturally, in the currency areas, when there is a lot of demand for dollar hedging and funding services, you're going to see a significantly higher interest rate in the implied dollar markets from the swaps as opposed to from the direct dollar markets. Okay, so that's why it's very important. It affects the international transmission of monetary policy. Prior crisis, the Fed only needs to worry about one transmission, which is from Fed funds to the term dollar funding, and all the other currency areas is going to have the same exact implied dollar funding condition. Post-crisis is quite different. You have this full spectrum of pass-through that's different depending on where you are. Like in currency area with a strong dollar funding demand, you have much higher implied dollar interest rates, and in currency area with actually more demand for local currency. I don't know if it's easy to see. It's going to be the Australian dollar markets. The red line is actually persistently below the black line. Okay, so you have this very interesting differences in the international transmission of policy, which affects offshore participants and also US participants abroad. Okay, so now going back to the formal definition of CIP.
We had a
Yes.
question real quick. I think it's still on this chart. So why don't
Yes,
we,
let's
do
do that.
you want to ask your question?
Sure. Yeah. So I don't know if it's related, but like the deviation seems to get lower, like in amplitude wise, when there's tightening. And so I was just wondering, because in the first part of the graph, right, before 2008, we're essentially always in positive rates, right? Well, here we have like this there seems to be more deviations when we have like the zero lower bound essentially. So I don't know if it's
so there's a lot of good insights from your question. So let's look at the deviation alone. This one was was showing the level, right? So you actually have to impute the deviation using your eyes, and this one is showing you the deviation directly. And in terms of the deviation, I'm using the market convention, which is the difference between the cash market lending rate and the swap market lending rate or borrowing rate, depending on which side you want to think about. And for most of the currencies, it's negative. What you are asking is like during 2008, okay, there was obviously a big widening in deviation. And I think that's still very much related to the crisis dislocation. But what's different is that then the deviation normalized after the most acute period of the crisis, the widened again during the peak of the European debt crisis. But then you had like a very long period of very tranquil market conditions, right? Nothing was really happening, and you still have pretty wide deviation. And maybe that's the one where you had some intuition, like this is the period where like the ECB and also the Bank of Japan had like a negative rates, and seems to be like that might be a factor. So I think if we maybe defer the discussion, I do think the unconventional monetary policy, especially in terms of the asymmetry between the US and other low interest rate currency area, is going to be an important driver for the level of these deviation. Because again, like there's always a supply and demand side of story. I mean, the demand for dollar funding and hedging, I believe, is an increasing function of the difference in the monetary policy stance. If you think about US, it's like raising rates, like we saw how the rates were raised from that picture earlier on. US was doing that, but the ECB and the Bank of Japan were still adopting very accommodative, like negative rates, like a large amount of quantitative easings. So naturally, you can think about institutional investors in those low interest rate currency areas would want to invest more in US dollar denominated fixed income securities. And if their liabilities are still predominantly denominated in local currency, there's going to be a sufficient, I think a large amount of hedging demand, right? And hedging demand is essentially corresponding to like a short-term funding demand, because typically these institutional investors just roll over their short-term FX hedges, say on a month-to-month or quarter-to-quarter basis. And if you have an increase or shift out in demand curves, even you're holding the supply of intermediary capacity constant, you're going to have a widening in the CIP basis. So yeah, so I think it's related. It's certainly potentially related to the unconventional policy, not so much in the US, but also in the foreign currency areas in comparison.
There's one more question. Petra, would you like to jump in and ask it?
Yes, and I think you were actually just answering it as well. I was just curious about the previous figure to see that the Australian dollar implied funding cost actually dropped below the USD LIBOR. And if you can elaborate more on that, but you were just talking about it. So I was
right, exactly. So for Australia, it's exactly the opposite thing, right? Of what I was comparing between Euro area, Japan, and US. For Australia, it's the opposite problem because they are actually of higher interest rates compared to the US dollar. And there's quite a big demand for Australian dollar denominated assets, both in their securities, which is actually in short supply, and also like a booming real estate markets. So the problem they face is often the other way around. So like their local banks actually did not have enough funding locally in Aussie dollar deposit, then we need to actually go to the international markets by borrowing the US dollar and swap back into the Aussie dollar. So basically the funding, the demand side and hedging demand side is the opposite side compared to, at least on net at the economy level, compared to the dollar yen and the euro dollar market.
So it's one of the few exceptions when it goes the opposite way,
exactly.
Right?
So from this chart, you see the Aussie dollar goes the opposite way, the New Zealand dollar, which is the close cousin to the Aussie dollar, even though the economy is much, much smaller, goes the other way. And at the long end, the Canadian dollar also goes the other way. Again, like Canada most time has like higher interest rates than the US. So you already see it even before I show you a cross-sectional scatter later on, that there is going to be a very tight correlation between the level of these deviations and the level of nominal interest rates. And the intuition that I just offered in these past two Q&As, I think would give you a clue to make sense of this relationship, because the hedging demand is sort of different, and the hedging demand is a strong function of the interest rate differential.
Thank you.
Yeah, no problem. Okay, all right. So that was CIP, right? Observation-wise, it was not really there pre-GFC. It was pretty much persistent post-GFC. There are large fluctuations, not just during times of distress when there was guaranteed to be a blow up, but also in normal times for some other reasons. And again, like not surprisingly, during COVID, it blew up again. And there's also a very interesting tiering, like the colors do not change order very much. Like you have the Aussie dollar, the Canadian dollar, and the Kiwi dollar always being on the opposite side. And you have the yen, the Swiss franc, the Danish krone, and the euro to a large extent are always pretty negative, in the sense the implied dollar funding cost is pretty high for these low interest rate currencies. Okay, so that was that. And Alexi, what's your take? Should we take a 15-minute break now? Now we're sort of in between the materials, also
Yeah.
in time. Yeah, so
This
maybe
would be fine if this is a good place for it.
it's a good time to pause for 15 minutes so everybody can take some time to get coffee, and I'll come back to tell you why CIP fails to hold and talk more about the more big picture implications for it. Okay.
Great. So let's come back in 15 minutes. I guess that will put us at 10:37, everyone. See you soon.
That's right. Okay.
Thanks, Wenxin.
Thank you.
Okay, shall we start back up?
Okay, great. I hope everybody had a great break. Okay, let's start sharing again. So, let's see, full screen. Perfect. I think we ended here, right? So this picture shows there are large CIP deviations, not just during crisis, but also in normal time, post-global financial crisis. And if you follow the first part of this talk, at this point, you will say there has to be some balance sheet constraint on the intermediaries so that these wedges are not arbitrage away, right? So what are the wedges? What are the intermediation frictions and constraints? And that's the next couple of slides. So the way I think about it is there are, broadly speaking, two types of constraints. And so I have to have a specific story, a specific type of constraints for each of these two types of ways of doing a CIP arbitrage. So, so let's start with the baseline bank balance sheet in panel A, where we have some short-term lending, either in the repo market. This is just the jargon for repo market lending, RRP, or reverse repo facility. Sorry, not facility in this case, it's just banks reverse repo lending, and lending in the foreign exchange swap markets. So let's think about if we want to arbitrage like a dollar-yen basis, we're going to fund borrowing dollars and then lend that additional dollars in the dollar-yen swap markets. So that's what our usual, what's so-called the matchbook intermediation. So in order to do $1 more of dollar-yen CIP, I'm going to borrow $1 more in the cash markets, either repo or unsecured. I lend that dollar synthetically in the dollar-yen swap market. Okay, so that's method number one. There is an alternative method to do the CIP arbitrage only in this post-crisis QE environment with lots of excess reserve. And that's what's being labeled as reserve draining. So by the way, why is this called matchbook? It's called matchbook because there is the same increase in the liability. I have to borrow the same amount in order to lend the same amount. So there's a corresponding increase in assets liability. That's in the sense the bank's book is matched. There is an alternative way of doing this arbitrage, what we call reserve draining. It's in the sense, if you have a lot of excess reserves, I purposely added a word called drainable in front of reserves to highlight that not all the reserves can be used for arbitrage or for intermediation, but a part of that, if you happen to have some truly extra ones, are drainable, so that what you can do is that you can drain your reserve or use your internal source of funding in order to support lending. And as we'll see, even though the shadow cost of draining reserve is slightly different because of that IOER Fed funds rate or IOER private money market rate wedge, you still get a significant CIPs by draining reserves and then lending out that in the FX swap markets. So the wedge between the implied dollar interest rates versus the direct dollar interest rate isn't really that sensitive respect to the choice of interest rate benchmark. Okay, so what are the differences between these two business models or these two arbitrage strategies? There is a significant difference in terms of the implication for the balance sheet size, right? So far, we've been focusing a lot on the total leverage constraint. Then obviously, if these borrowing and lending additional amount cannot be netted, this model, the matchbook model, is not very popular because the overall balance sheet is larger as a result, right? And for very leverage ratio constrained banks, this may not be feasible. During times of distress, the bank treasuries may only allocate very limited balance sheet capacity to specific business lines. So may not even be possible for that specific CIP desk or cross-currency basis desk, so to speak, to engage in more trades by borrowing the cash markets and lending in the swap markets. So that is constrained. So in some sense, the reserve draining might be a workaround, right, for leverage constrained global banks if they want to do more, especially on the very stressful days. And if you happen to have extra liquidity internally, given it's already on their balance sheet to begin with, then they can do more on that specific day very proactively. Okay, so that's the difference. But this reserve draining obviously doesn't solve all the problem. Why do I say so? Because for a very long period post-crisis, like before we're talking about reserve was shrinking to maybe it might hit the portion that the curve was downward sloping. But for a long time, we weren't in that regime. Like we were in a very ample regime. Reserve was clearly abundant for the entire banking sector, but we still had a lot of CIP deviations, right? So there has to be some additional specific constraints and frictions that are associated with this reserve draining model that goes beyond the usual leverage ratio consideration, right? And in addition to the leverage consideration, I also want to flag for another key pillar under Basel III, the liquidity coverage ratio. You might be concerned, does that mean now you have more lending in the FX swap? You have lower amount of reserve. Does that worsen your LCR? And the short answer is not necessarily, because typically what ends up happening, how do you actually drain reserve to do more CIP arbitrage? So you're gonna run down your dollar reserves at the Fed. So you're gonna sell that dollar in a spot market, say in the dollar-yen market, you get yen. Where do you put that yen cash? You again park that yen in the deposit facility at Bank of Japan. And then you know BOJ is not going to default on you. So next period, say either after a day or a week, you're gonna collect the interest and the principal from BOJ. The total amount might be smaller because of the negative rate imposed by BOJ, but that's not a problem. You're gonna get back that cash in yen with certainty, and therefore today, you're going to sell that amount of yen forward in the FX forward market in exchange for dollar, so that there is no dollar-yen exchange rate risk, okay? And that's how you do it. And the implied dollar interest rate, by taking into account the negative interest rate from BOJ and this cost, which is equal to the outright difference in the lock spot and the forward exchange rate from the dollar-yen market, turned out to be consistently higher than the interest on reserve paid by the Fed, okay? And why is it LCR neutral? Is because you're just swapping reserves at the Fed with reserve at the BOJ, and both central bank reserve are considered level 1 high quality liquid assets. So you stay LCR neutral by doing the CIP arbitrage. So it's not the Basel leverage ratio, and it is not the Basel liquidity coverage ratio. So you have to think something a bit more subtle to justify for why at least these large banks with a lot of reserves in the US play a more active role in arbitraging the CIP. Okay, so but still, let's go with this case first, and then we're gonna speculate a bit on what else can go on with this case, which is still a bit more work in progress, as I would argue.
Wenxin, just real quick, what about non-banks? So like, why can't hedge funds, and others?
Definitely. That's a very common question that's asked when we take a very bank-centric approach to explain things. The short answer is, so non-banks, there are different types of non-banks, and the story for each of them is slightly different. The canonical arbitrageurs in the standard limit to arbitrage literature is to think about very active levered investor like hedge funds, because they take on leverage. You think they may have larger price impacts. In this case, they're not useful at all, because where do they get leverage? They still get leverage from their prime brokers and their repo brokers, which are still these large dealers affiliated with bank holding companies. So if banks cannot use their own balance sheet to do the arbitrage, they're not going to give the balance sheet space for free to finance hedge funds in order for them to do the arbitrage. So the story is whatever the implied cost of getting leverage to do this fixed income arbitrage is going to probably high enough so that it's not profitable for hedge funds to do it, taking into account the cost of borrowing from banks. So hedge funds are ruled out, and then we have to have some other non-levered investors or real money investors endowed with a lot of dollars and has sufficient amount of discretion in what they can invest. So the large sort of fixed income, like short duration bond funds, are usually not nimble enough. So they still care a lot about tracking specific benchmarks, like adding CIP can improve their portfolio returns, but at the expense of introducing a benchmark tracking error. So in my view, it's not possible for these very well-established sort of PIMCO funds to allocate a lot of space into CIP. I think they are doing quite a bit if you go to like their filings, say in Morningstar or website, and oftentimes you see sort of a lot of the very constrained versions, unconstrained versions do have their top holdings in yen. And as we know, right, the yen has the lowest nominal interest rates, but on the FX swap basis, they're pretty attractive because of the direction of CIP and the direction of dollar funding shortage for the Japanese market. So large institutional investors, in my views, are oftentimes not nimble enough and cannot have dedicated enough assets to this line of business. Then this leaves like a very special type of market participants, which are these central bank FX reserve managers in a very good position. If they're not very conservative types, like for instance, the Reserve Bank Australia, I think has like basically made it pretty public, like this is in their business strategy to manage their FX portfolios to do a ton of CIP. So investing yen and swap back into dollar if they want to have dollar exposure. I think data was pretty public, and the deputy governor, Guy Debelle, used to give a speech at the BIS CIP symposium titled something like why I started from hating CIP to loving it. So I think there are certainly non-banks that are pretty active in this. And I also gave a, so I'm not gonna go into more anecdotes, but yeah, there are certainly people who are doing it, but whatever the activity is ongoing is not sufficient, arguably, to replace this inactivities by the global banks post-GFC. Prior to the GFC, the FX desk in this space and the LIBOR desk literally sit next to each other, right? So if there's like a 1 basis point difference even, like between the two desks, that's arbitrage immediately. Like you just don't have that amount of sort of depth in the markets, or essentially if everything's unsecured, that's also in the sense infinite leverage. We just don't have that amount of arbitrage anymore. So things are still there, even despite these central bank arbitrage actively. Okay, so all right, so good discussion, and don't see any more questions for now. So let's first discuss the leverage constraint. Even though we discussed that in the context of IOER, let's be a bit more specific for CIP and look at more striking quarter-end charts. So we talked about the non-risk weighted capital rules, the Basel III leverage constraint, and the US implementation supplementary leverage constraint, and it makes the matchbook intermediation more costly because matchbook, if you cannot net out the borrowing and lending, you're going to end up with a larger balance sheet. For the repo market intermediation, there is actually one way to net it through the so-called sponsored repo. But for FX, not to my knowledge, it's not possible to net. In addition to the usual quarter-end dynamics, as we discussed, because outside many non-US jurisdictions, the leverage ratio is assessed based on the quarter-end snapshot of bank balance sheets. There is additional kick on year-ends because large global banks also face the so-called GSIB capital surcharge. And if you type in GSIB capital surcharge in Google, you're going to find some BS article which gives you different components of the GSIB surcharge score. And that's how the surcharge is based. So you tackle the score, which is like a complexity score. Like JP Morgan always has the highest score, being the highly, like most complex banks globally. And if you have a high score, you might be in a higher bucket for GSIB capital surcharge, which is like an increase for like a whole year after the score is calculated. So it is very costly. And it happens to be that the FX swap crosses pretty much all dimension of the GSIB capital surcharge. So there is, I think, one dimension about the use of derivative, one dimension about cross-jurisdiction, like most of these FX activities cross-jurisdiction. The US implementation also includes the use of wholesale funding, et cetera, and also size of balance sheet itself is an important dimension of the GSIB surcharge. So FX, in addition, also affects GSIB surcharge. And interestingly, the GSIB surcharge score is often calculated based on the year-end snapshot of bank balance sheet. And therefore, as we can predict, the year ends are going to be associated with like worse dynamics for CIP deviation compared to a regular quarter ends. Okay, so, and that is the somewhat famous charts here. So what we have is we have a lot of shadings. What are the shadings here? The blue shading denotes the 1 week prior to the year quarter ends, and the yellow shading denotes the 1 month before each quarter end. So what we see is that for a 1 week contract, taking the dollar yen as example, plotting just flip the sign because it's usually negative to make the spike more clear. I flip the sign. So this is the negative of the dollar yen basis. We see that it spikes exactly 1 week before the quarter end, stays high, sometimes even increase as we close to the quarter end or year end days, and then normalize after the quarter ends. And similarly, for a 1 month contract, you would spike exactly 1 month prior to the quarter ends, and then stay high and then normalize soon after quarter ends. So for contracts that show up some period ends, the shadow cost associated using up bank balance sheet constraints significantly higher. And therefore, it's no surprise that the CIP deviations crossing these period ends are also significantly higher, right? As we discussed, the year ends are much more perverse compared to an average quarter ends. Like this is the year end 2017 for euro dollar, which is not shown. This is showing dollar yen for both markets. The 1 week CIP deviation reached close to like 900 basis points. That's like 9% in the interest rate environments when the risk-free rate was still pretty much close to zero. Okay, so this is pretty dramatic, and this is being used as very good evidence, suggesting that there has to be some leverage constraint, because that also the GSIP surcharge is making banks additionally constrained on year-end days. So these deviation, at least in part, reflects the bindingness of these constraints. Okay, any questions so far? Okay, so we're good to move on. The next thing is the more subtle thing, right? So if I'm just showing the leverage constraint, then you might wonder, okay, I understand this, but banks don't start with borrowing. They already have a lot of liquidity on their balance sheet thanks to QE, right? We had a ton of reserves, like at the peak of COVID, we had 4 trillion, but even before that, for a long time, the banking sector had like close to $2 trillion reserves. And those are not all required for the liquidity coverage ratio or other reasons, and therefore should be able to be actively deployed to support these very bad, stressful days. Like, why isn't it happening? Okay, so this is the part, as we have explained, is not due to the usual Basel III regulatory metrics, so it's a lot more subtle. So there are 2, I would say, important consideration or in terms of constraints that limit the amount and effectiveness for large global banks to engage in this so-called reserve-based or reserve draining arbitrage or intermediation. The first one is pretty much, I think, prominently discussed in the recent working paper by Adam Copeland, Darryl Duffy, and David Young, which is making an argument that despite the fact that draining reserves to support more lending, either in the repo, which is the focus of their paper, but also by analogy in the FX swap market, is LCR neutral, it does worsen the intraday liquidity of banks' balance sheet. Because as we also discussed early on, what is reserve? Reserves are cash. Cash can be used to settle instantaneous liquidity demand even in the next 5 seconds. But if you lock down that liquidity, even on a very short-term basis, overnight, or in the case of CIP, typically like a couple more days, because even the FX spot settlement takes 2 business days, like the whole portfolio, bank portfolio has worsened intraday liquidity. And is that a problem? It can be a problem both for regulatory and for self-imposed risk management business practices. So in Copeland, Darrow, Duffy, and Young, they discussed like intraday liquidity constraint imposed by regulation as a part of the resolution planning process. So the resolution planning rules are these set of rules that require large banks to have like a living will, so that in the event of resolution or bankruptcy, there's going to be orderly plans for liquidation, and they have to keep sufficient amount of intraday liquidity. That's at least could be banks' own interpretation. They have to keep a sufficient amount of intraday liquidity in the form of reserves, as opposed to lending them out on a very short term, like overnight or term lending basis. So that makes the reserve draining not always working, right? Because if banks have reasons to hoard the most liquid form of intraday liquidity in the form of reserves, as opposed to lending it out. There's also an important dimension of the resolution planning rule in our view, which is discussed in this other working paper, which is in the sense, like this planning rule not only requires US banks to have sufficient amount of intraday liquidity, but also the distribution or where the liquidity is can also matter. So this rule requires US G-SIBs to hold sufficient amount of liquidity in material entities at the time of bankruptcy filing to ensure successful resolutions. And going back to our CIP example, this is like a very interesting case where the distribution of liquidity differs significantly depending on whether you hold that at the Fed versus you lending that out in the dollar-yen swap markets, then the liquidity will be at the BOJ. And if you lend it in the dollar-euro market, liquidity will be kept at the ECB instead. So if the bank's underlying assumption is that during times of resolution, the local regulators at the ECB, at the BOJ, will ring fence those liquidities. So US banks will not be able to get those liquidity back to the US where it has most of its material business activities. That will be a problem. So banks are quite reluctant. And also I think by conversations with actual bankers, this is a big part of their considerations. It is not optimal, at least on an ongoing basis, even in normal times, to have a lot of liquidities located outside the US. So I think both reasons that are in this slides are important reasons for us to rationalize for why there seems to be a lot of hoarding of liquidity inside the US, where the shadow cost of them seems to be significantly higher in the offshore dollar funding markets. Okay, so this is the illustration where I think I was verbally describing to you when we look at the diagrams for the reserve draining. What this is actually showing is you can calculate an overnight version of CIP deviation based on the interest on reserves paid by different central banks. So how do you calculate that? If you're interested, you can look up a recent forthcoming handbook chapter. In the longest footnote in that handbook chapter, we tell you how do you calculate the overnight CIP basis. It's a little tricky because as we discussed, the spot contract settles with the T+2 convention. So how do you actually have an overnight FX swap? It is possible. It's a bit more tedious that I'm not going to go through. But say if you do that calculation, you end up with this chart. And the blue line is showing you the CIP deviation on an overnight basis between the implied interest rate from the Bank of Japan's interest on excess reserve versus the IOER we discussed paid by the Fed. And the red line is the similar object corresponding to the implied dollar interest rate from ECB's deposit rate swapping to dollars and compared to the interest on reserve paid by the Fed. And despite the fact that both central banks in our sample on this chart pay a negative interest rates on their reserves, on the FX swap basis, every day almost, their implied dollar interest rates are significantly higher than this interest on reserve paid by the Fed, which never went negative. Okay, so every day large global banks are foregoing like literally free money on the table, not willing to swap the ECB and the BOJ deposits with the Fed deposits. So I think this really speaks to the boundary, right? The distribution of liquidity, I think, play a very sufficient, presumably playing important roles in banks' reluctance to do more in CIP. And the other consideration is on these very, very stressful days, right? We talk about these year-end spikes and quarter-end spikes, and we talk about it's largely driven by this leverage ratio constraint coming from non-US banks being calculated on the period-end basis. There's a natural question on the role of US banks because US banks leverage ratio is calculated not on period ends, but also just as a daily average. So in theory, US banks should be very active on these days so that they can potentially bring down these bases because their activities on the particular day is not going to matter so much for their overall bindingness of the constraint for the entire quarter. And in practice, do they actually do that? So this is in this working paper, we're trying to investigate at the actual activities done by US banks, arbitraging CIPs on these quarter end days. So what we find is that this is not just for the FX swap market lending, but also trying to show you the full balance sheet in terms of these very short-term liquid component of the balance sheets. We do see that there's some evidence, yes, based on our measures, they do increase their FX swap market lending slightly by about $20 billion. Directionally, it makes sense given European banks are contracting, US banks should step up, but magnitudely, it is fairly small. I mean, compared to the size of the markets and compared to, say, how much reserve they have. Very important finding is this $20 billion isn't financed by matchbook. If anything, their external repo borrowings on quarter ends also contract by about $30 billion. The external repo lending stays roughly flat. So overall reserve actually declined for US GSIBs by about 50 billion to make up this 30 billion loss in external financing. So basically US banks also contract their external financing on quarter ends, but they drain their reserves more than offset this loss in external funding. So overall, they're able to lend additional $20 billion. And this $20 billion are happening at the same time that we still have these spikes in this quarter end CIP deviations. So you can argue that maybe there is going to be there are indeed some additional constraints to drain this reserve down further, that they're not comfortable, say, having like 100 billion reduction in reserves, because that corresponds to 100 billion reduction in liquidity inside the US, or 100 billion reduction in the most highly liquid version of liquidities. So maybe they're not comfortable. That's explanation number one. I think there is some truth to that, especially after to the talking to the bankers. There's also, I think, another potential important explanation that's based on market power, right? I mean, if US banks are the only players in this markets at that time that can play a more active role, then maybe it's not in their interest to arbitrage that basis down to zero or down to a more normal level, right? I mean, think about them as a monopoly, and there is like price discrimination, and they would charge a markup. And I think there was a job market paper a couple of years ago by Jonathan Wallen from HBS that's more around that line of thinking to explain these spikes. Why are spikes still there, despite that US banks have potential to do more, but in practice, they don't seem to be doing a lot, and the spikes are still quite prominent. But if anything, I think we can say that if in the counterfactual world, if the US banks did not even increase this 20 billion, like the whole quarter end spikes might even have been even higher. Okay. Any questions over?
These spikes really look gigantic in the overnight picture. It goes up to 1,200 basis points. It's not very long lasting, but it's
one day for overnight.
You'd want to throw a lot of money at that if you could. Did you mentioned that the data for the next slide is transaction level? So are you able to tell like which banks are doing it, anything like that, or is that not?
Yeah, so this one, we have essentially the daily version of the balance sheet for the 6 largest US GSIBs. And so of course you can look who is accounting for more, but because there are only 6, we cannot really do much in terms of telling you which one is doing more. I mean, there are already just these 6 well-defined GSIBs. So there are 8 GSIBs in the US. We take out State Street and Bank of New York Mellon because of their large custodian business, but all the other 6 essentially aggregate up to the pictures here. But in the paper, at least in the more recent version, there is a more cross-sectional analysis between the US GSIBs and foreign banks. So there's a larger cross-section. And basically, it's consistent with what you expect the larger banks in terms of their repo activities and reserve amounts end up being more active in draining their reserves and supporting additional lendings on quarter-end days. So if anything, on these very stressful days, because we discussed the total amount of reserve before this big explosion of the overnight RP take-up is essentially fixed by the Fed. So on a very stressful day like quarter end, what you can change on the margin is really just the distribution of reserves across banks. And it's pretty clear in the data, the large banks drain their reserve more, and the smaller banks and the overnight RP facility become the passive recipients of these reserve flows. Yeah. Okay.
Are there any questions? Anyone want to jump in? Feel free. If not,
Okay, very good. All right. So,
yeah.
Okay, move on. Perfect. So that was on the supply side in terms of intermediate constraints that prevent these arbitrage from being arbitraged away. We talked about both the leverage constraint and also additional more subtle reasons that affects reserve draining. And we talk about some other implication potentially or hypothesis, such as the US banks want to charge a markup and not willing to do a ton on these very stressful days. Okay, the next question is, these deviations should not exist in the first place if there's not like a demand for dollar funding or hedging, right? It's like for any of these arbitrage, I already repeated myself multiple times, you need to both have a story from the demand side for why the arbitrage exists in the first place, like why the gap opens, like why the implied dollar interest rate from dollar yen and dollar euro is higher than the direct dollar interest rate. So that is the story on the demand side that is determined by the structure of the financial markets, by market segmentation, for instance. And then you have the supply side story, which we just covered in terms of why the gaps are not arbitraged away. So this next couple of slides, we're trying to understand a little bit more about the demand side story, about why the gaps exist in the first place. Okay, so I would say this part is a bit less researched compared to the earlier part on the bank's various balance sheet constraints, but there is already some literature that covers this part. So first of all, we have to ask ourselves who actually demands dollar in the swap markets. So broadly speaking, there are three types of market participants. The first one is very prominent. I think there are a lot of non-US banks who just do not have the international brand name and credit rating and the market access. So they just do not borrow much, like in the repo, and they cannot borrow from money market funds. Money market funds are only allowed to lend to a certain group of top tier, very elite global banks. So there are a lot of non-US banks who need dollar for whatever reason, like their clients need to do like trade invoicing, or they have dollar denominated assets. They need dollars, but they cannot get dollars. So there's always this residual funding markets, which is FX swap. You convert your local currency deposits into dollars. That's always an option, but the drawback is it might be quite expensive. Okay, so and there's some literature, like I think a very well-known paper is the Ivarstein, I think the date is wrong. This is like during the European debt crisis. And the reason is that a lot of European banks, they historically borrow from private money market funds, and there was a big increasing risk aversion among the money market funds in the US because the whole sovereign debt crisis in Europe. So there was a big cutback in direct funding to the European banks. And as a result, these European banks had to borrow synthetically in dollars. And that is the reason for why the CIP deviation was so large during the European debt crisis. So it's a very bank specific story. And I think another anecdotes, or I mean, let's say anecdote, I think empirical finding is, I believe there was like a New York Fed staff reports that basically by comparing the CIP deviation in the morning when the European banks are actively trading versus in the afternoon in the US trading hours when the European banks are not opening. So you see actually much larger deviations in the morning, which suggests like European banks' demand for funding can be an important drivers of CIP deviation. So that's on the demand side, right? I mean, even though we're talking about banks, we're sort of thinking the special type of banks, these banks that are more agile in switching between swap and cash market funding. These are not the intermediaries, but they're the customers. They're the user, the end user of the swap markets, and they can be quite important. The second one is the one we have talked quite a bit in different perspectives. Those are the non-bank financial institutions. So we talk about mutual funds, pensions, and life insurance. And in particular, I think I've given you anecdotes, which I think is actually well established, like the life insurance companies in particular, especially coming from Japan, have large amounts of US dollar denominated assets. And based on the semi-annual public filings, they do maintain a hedge ratio around 50% of their dollar assets in Japan. In Europe, the hedge ratio is probably much higher because of the capital regulation penalize open FX positions a lot more from Solvency II as opposed to compared to the Japanese local regulation. So overall, for these institutional investors with local currency denominated liabilities, say for the search for yield reason or to satisfy certain minimum return guarantee, they will have to invest in US dollar fixed income, and the corresponding hedging needs is a big part of the demand. Okay. And I think in terms of numbers for Japan, even for like maybe just the 8 life insurance company that published their hedge ratio, you can easily get like maybe 300 billions of hedging demands coming out of Japan. So numbers are very, very large from that category. And thirdly, so far the bank's funding we think is a bit more on the short end of the curve, and also these institutional investor hedging strategies are also typically short term because their definition of currency risk for long-term 10-year US corporate bond is not the FX fluctuation in the next 10 years, it's literally the dollar-yen fluctuation in the next quarter, which is their holding period, right? They evaluate their mark-to-market gain and losses for each quarter or each month, and therefore they hedge their FX exposure by rolling over these short-term FX hedges, like either in the forward or in the swap markets. So they're users of very short-dated FX hedge. There is a third category of demand or end users in the swaps that operate at the more medium to long-term and long-term of the curve, long end of the curve, and these are the corporate issuers. So corporate issuers, very sophisticated ones, and especially the ones that have a large international presence tend to issue where it's cheapest on the FX swap basis. And after sort of looking at the pattern of CIP, you might conjecture, okay, that means there's always a correct answer. You should always issue actually in the Aussie dollar and in the New Zealand dollar markets, because based on the picture we have seen on the FX swap basis, the synthetic dollar interest rate tend to be lower in those markets compared to the seemingly cheap markets like the yen and the Swiss franc. Turned out that intuition is only correct for very high rated international issuer that has very good access to different funding markets. For most of the multi-currency issuers, they tend to have a funding cost advantage in their local currency. Or sometimes, I mean, the cost differential might be reacting to differences in unconventional policy. For instance, it's possible when the ECB was launching aggressive QE or asset purchases for corporate bonds, the euro area credit spreads tighten, so it could be temporarily more advantage for US firms to issue in euro and then swapping back into dollars. But overall, these issuer-specific cost advantage doesn't necessarily follow the broad pattern of CIP because each issuer has differential access to different credit markets. So therefore, this third item, even though it's quite a distinct possibility and it's an important type of usage for long-dated swaps, it doesn't always line up with the CIP, at least based on the LIBOR rates. And it's not always an option for each individual issuer, okay? So this is the charts that we already saw and predict when we look at the first chart for CIP. This is the striking correlation in the cross-section between the level of CIP basis or cross-currency basis with respect to the level of nominal interest rates, right? We know the Aussie dollar, Kiwi dollars are on the positive sides. Implied dollar interest rate is lower than the synthetic dollar interest, than the direct dollar interest rates, and the low interest rate currencies are on the other hand. Okay, and we already discussed like one hypothesis to explain this is you have to have a different story on the demand side between a high interest rate currency and a low interest rate currency. For a low interest rate currency, there is a lot of demand to funding dollars, and for a high interest rate currency, it's the opposite. There's a lot of demand to funding local currencies. Okay. So, and another thing I want to highlight, which might already be pretty clear at this point, is because of this pattern in the cross section between high and low interest rate currency for CIP, the trading direction for CIP is exactly the opposite for the trading direction for the unhedged conventional UIP or carry trade, right? I mean, for people who are somewhat familiar with the FX literature, you know the most popular trading strategy is the carry, which means you should go long in high interest rate currencies and short low interest rate currencies, and without your interest rate hedged. So it's a pure speculation. And it turned out on average, the high interest rate currencies do not depreciate nearly as much compared to the implied interest rate differential. So on average, that trading strategy annualized ends up with, I think, a 6% annualized return over a pretty long time period after including emerging market currency, I think. So that is the carry, or even in G10 currency, I think you can get maybe like 4 to 5% on an annualized basis for the interest rate carry strategy. But the CIP is exactly the opposite. You want to actually go long in the Japanese yen and funded by the Aussie dollar or the US dollar. And in this case, you want to leave your currency risk fully hedged, right? Because we're not in the business of speculating exchange rate movements. And in this case, so it's exactly the opposite. So why is that interesting? So if you think about like in this international financial world, I mean, we have a lot of client demand of the traditional carry, right? And intermediaries has to be willing to supply the opposite side of the trade. So the client wants to go long in Aussie dollar and short the Japanese yen. The intermediary has to be willing to go long in yen and short Aussie dollar on net. And the intermediaries are collecting a fee to provide that service. That's why intermediaries are oftentimes hedged. So if you carry that intuition out, then it's not, I mean, so hard to rationalize why the pattern of CIP and UIP trades are exactly the opposite to each other. Okay, so that's usually how I think about it myself. But I think overall there is definitely like opportunities to have something like more structure, like say in terms of a model, like for exchange rate determination that features both like a spot market, but also a forward market, trying to basically make the points that I just mentioned a bit more clear in the model. All right. Okay, so so that was the demand side in terms of the interest rates. And the very next thing that I want to discuss, I think is important when we talk about the central bank policy, is that this market seems to be pretty crazy, right? There are these large spikes, and the spikes both happen predictably because of quarter ends, but also unpredictably because of like the COVID or the financial crisis, etc. So what can central banks do to address these wedges? And we do have a very, very important tool to address deviations from CIP in particular, and that is the central bank swap line. Okay, so how does the central bank swap line work? So the central bank swap line, let's take an example between the Fed and ECB, is agreement that on demand, the Fed is going to be willing to give dollars to the ECB. So ECB now has dollars from the Fed, and the ECB can decide how to allocate the dollars among its banks. What happened in practice is the ECB would conduct dollar auctions, and the banks would pledge the eligible collateral with ECB and get the dollars and essentially distribute the dollars from the Fed. Okay, so this, as you can imagine, can really solve the gap between the imbalance in supply and demand. And this chart is showing you the take up in the swap line facility based on this blue area, and the scales are on the right. So the central bank swap line was always one of the most active used liquidity facilities during a crisis. And the numbers are pretty large. At the peak of GFC, the take up reached to, I think, close to 600 billion, and was accounted for, I think, at least a quarter of the Fed's entire balance sheet. And similarly, this time around, if you look at the crisis response, comparing with all the other facility, the swap line was the largest take up. Again, like we have over like 400 billion take up. So that's the first observation from this chart is the swap line was actively used 3 times. The GFC, the European debt crisis, and the most recent March 2020 COVID distress. Okay, so the second thing is the swap line isn't so much used outside this crisis period, right? So what we have here is we have a couple of price lines. The red line is the swap line official rate. So how is the swap line official rate determined? It's OIS plus a spread, and the spread is an administered rate that the Fed can adjust. It used to be like 100 basis points at the peak of GFC. It was lower to, I think, 50 basis points. I could get it wrong, but you can look it up during the European debt crisis to encourage more active take-up. And at this time of the COVID response, I think it was 25 basis points above OIS. Okay, so what we have is this orange line or the red line, which is the official rate that you can borrow, like a foreign banks can borrow from their central banks after going through this central bank swap line, getting the dollar from the Fed. And that rate can actually be lower than the private implied borrowing rates from the private FX swap market. And what you see here is that the green line, which is the implied rate from the 1 week dollar yen swap market, and that 1 week line on quarter ends are almost always much higher than the swap line rate. And also even outside the quarter ends, like for some specific quarters, like every day, the cost is significantly higher than the swap line rate. Then did people actually borrow in the swap line when it was very, it makes economic sense to borrow. It's very cheap to borrow. It's cheaper to borrow in the swap line economically compared to borrowing in the private markets. And the answer is no. I mean, you can see a little bit of take up on quarter ends. I mean, on average, I think this average out to just maybe a couple $2 billion. So yes, it's price sensitive. When the prices are really, really high in the private markets, you have a slight increase in the swap line take up, but it's really not a big deal, right, compared to this crisis take up. So how do we explain this? Maybe this is not too surprising for you, like by looking at any central bank facility in this way, like the reasons for low historical take-up, I think can be attributed in part to stigma associated with tapping central bank liquidity in the non-crisis environments for day-to-day liquidity management. There could also be moral suasion from central banks. It's like, just use this as a liquidity backstop. Do not think about using it in normal times. There's also balance sheet implication for using the swap line, just the same way as using as borrowing in the cash markets, right? Like swap line is still on balance sheets, so it doesn't really solve, if balance sheet constraint is the problem, it doesn't necessarily solve that. And how about the high take up during crisis? The high take up during crisis, it's exactly the opposite story. There is not much stigma because everybody is in crisis. I mean, please feel free to use it. And central banks are not giving any moral suasion. They're saying, please feel free to use it. This time around, there was a very important calibration in the swap line operation is instead of having weekly operation, the COVID response made it into like a daily auction. So that made it more frequent, and take up also followed immediately after parameter was recalibrated. And this time there was a lot more use, this time meaning the March 2020, there's also a term version, which was very popular. There's a lot more term, like 3 months, being able to lock in 3 months term funding at a very attractive rates led to quite a bit of take up. And obviously in the times of crisis, there is much more disruption in the cash markets, and therefore people had to borrow more in the swap markets. So overall, I think our understanding is the swap line is the liquidity backstop. It doesn't help fix the day-to-day CIP on an ongoing basis outside crisis, but when things get really, really ugly, it is quite effective and people are using it. Okay, so and the broader implications for financial stability, as we know at this point, is there is this whole constellation of interest rate, if you like to think about it, and the implied rates from the FX swap is often the highest the most fragile rates in this entire ecosystem of money market rates. So what we end up having is the FX swap rate is higher than the LIBOR, which is similar to the CD and CP, is higher than the OS, and Fed funds is higher, which is then higher than repo. So in terms of the crisis response, right? I mean, we all know the importance of keeping this modern blood of financial system, which is the dollar funding markets, like function. That's very, very important to restore like normalcy during the crisis period. And if you're able to actually fix the biggest problem, if you're able to fix the highest rate, the most fragile rate through FX swap, then everything tend to like fall in order. And that's essentially what we had like through the past 3 episodes of experience. It's like once the FX swap market is more orderly, like the other parts of wholesale funding markets, even without like active take up in whatever respective facility, also came back to order. So if you go back to the day-to-day sort of market reaction in March 2020, I think you can pretty much find this pattern that I'm verbalizing here. So therefore, I think the swap line is very, very important. And getting the FX swap market into order is important policy priority, especially for a crisis response. Okay, so I think that's actually all I want to say about the CIP for now. Of course, we can discuss more later on, but if there are any other questions at this point, I'm happy to take them.
We do have one question. Yvonne, do you want to jump in and ask it?
Yeah, sure. How are you? Thank you for your presentation. In your opinion, are the constraints that you describe a factor in the trend of the increasing share of non-banks lending in cross-border financial flows?
Right. So you're asking, are the constraints a factor? I see. So I think you're asking the question, now banks are very much constrained, then can non-banks play a more active role, right? So I think the short answer got to be yes. But as we discussed, a lot of non-banks still have a leg in this banking space. For instance, the levered investors often depend on funding from the banks, so it's not so easy to separate them out. And also, as we discussed, there are some inherent market segmentation due to regulation and mandates that do not necessarily connect non-banks with each other. Right, the world would be much easier. This money market problem, like offshore, would be much easier to solve if we can bring the lenders and borrowers closer to each other without going through the banks as intermediaries. So the fact that you're pointing, maybe there is some more cross-border flows among them, that's certainly encouraging. So whatever like evolution in the underlying structure that bring them closer. Yeah, like if you can connect like Warren Buffett with like a Japanese life insurance companies, I would say yes, definitely it helps alleviate the need for intermediation, that helps alleviate the balance sheet constraints. Yeah. All right, excellent. Okay, so last 30 minutes, and I do want to leave a little bit time for more open discussion. So this next part will be relatively short. So we are switching to talk about US Treasury again. So this one is regarding the negative swap spread or the inconvenience of the US Treasury bond, which might be a little bit provocative, right? Because if anything, all the literature that you may have read is regarding that the US Treasury market is one of the safest and most liquid markets in the world, and therefore there is a convenience yield, right? I mean, we believe the yield on Treasury is low because Treasury securities are in high demand. People like its liquidity, like its safety, so it should be trading below some similar fixed income instrument with the same cash flow. And the very good example is the Treasury yield is oftentimes below a similar very safe agency debt in the context of the US market. There is an agency named Resolution Funding. It's like the short name is, I cannot remember the full name, but the short name is RevCorp. And I think it's a resolution, whatever. And RevCorp yield is consistently higher than the US Treasury yield. And the gap between RevCorp and the Treasury yield is a very concrete measure of Treasury's convenience. Okay, so that's, I think, pretty well understood. However, the recent dynamics, as I would argue, really cast doubts on whether the long-term treasury is the ultimate safe, liquid, and convenient assets. So why do I say so? There are a couple of bullets here, so I do want to spend a little time to discuss each. The first one is there is an emergence of a negative swap spreads. So what is a negative swap spread? The swap spread in this case is defined according to market convention as the difference between interest rate swap, historically indexed to LIBOR, but now you can also use interest rate swap indexed to the Fed funds, which is the OIS, minus the treasury yield. So if you think about treasury is convenient, so both swaps and treasuries are of same maturity. If you think treasuries are convenient and the swaps are not, then it makes sense to have a positive swap spreads, right? Because whatever is convenient should be lower yielding. Investors are willing to forego some extra yield in holding that convenient assets as opposed to holding some interest rate derivatives which do not have any convenience. So, and plus that interest rate derivatives is indexed to a bank rate, and the bank rate is unsecured, even though it's OIS indexed to Fed funds. We know Fed funds is unsecured, and not to mention LIBOR, and the 3-month LIBOR is certainly not secured. So positive swap spreads prior to the GFC makes perfect sense. There is nothing strange about it, either from credit perspective or from the convenience of treasury bond perspective. What's quite puzzling is that post-crisis at longer dated tenor, as we will see, we began to have a negative swap spreads. So the treasury yield is actually trading above interest rate swap, both LIBOR and OIS of the corresponding maturity. So this makes no sense, right? If you take the view that the treasury is convenient and interest rate swap has credit risk. So it's like our IOER arbitrage, like this makes no sense. Like, why is this very safe government rate with the best liquidity and safety actually becomes a ceiling as opposed to a floor? It's exactly the same thing. In order to understand that, we have to understand post-crisis. Again, when balance sheets are more constrained, the treasuries are different from interest rate swaps because the treasury securities are on balance sheet. If you think about intermediaries are holding treasury bonds, that takes balance sheet space. If you think about intermediaries are providing the repo financing for hedge funds to hold treasury bonds, that repo financing takes balance sheets. So which perspective you take doesn't matter, but thinking about in order to finance treasury security, there's going to be an expansion in the needs on the intermediaries balance sheets in order to accomplish that. Whereas the interest rate swaps are off balance sheet, only initial margin and variation margins associated swaps are on balance sheets, which is just a couple of % of the notional. So if you take that perspective, whatever stuff that's on balance sheets because of balance sheet constraint post-crisis become much more inconvenient. It becomes easier to understand why you have a negative swap spreads and why treasuries might be inconvenient. They're still convenient relative to Ref Corp because both Treasury and Ref Corp are on balance sheets. So relatively, they're convenient relative to on balance sheet cash securities, but it's very likely that they are inconvenient relative to off balance sheet derivatives. Okay, so that's the first thing, which is going to be the focus. I do also want to point you to another direction to think about why long-term treasuries may not be as convenient as you think from an international comparison based on CIP, because we just did that, right? So it's nice to also have a quick review. So what you can do is, in this case, I'm gonna compare treasuries with another on-balance sheet securities, but not Ref Corp within US dollar. I'm gonna compare with swapped German bond or swapped like British gilt or swapped like Danish government bond. So I'm going to compare the US Treasury yield with some safe haven equivalent in the G10 currency, not taking the peripheral, like not taking the Italian, the Spanish, but taking the core countries and taking the countries with independent monetary policy as a benchmark. And we also see that there's been a diminishing in the convenience or the CIP deviation between the US Treasury bonds and these safe haven equivalents. And finally, very concretely, looking at the experience in March 2020, what we had is that Well, the T-bill, the short-dated treasury bills were trading negative, meaning there was a rally. There was such strong demand for short-term treasury security, but at the long end, there was a big spike up in the yield or a big spike down in price for long-dated treasuries. So if you like to think about the beta, right, the beta of the treasury bond return with respect to the business cycle or respect to the S&P, it's no longer guaranteed that the treasuries are a good hedge against the very adverse scenarios. At least during COVID, there was like one big data point that goes the wrong way. So long-term treasury can also be risky or inconvenient from that experience. Okay, so overall, this is trying to give you some basic understanding and intuition that I think we can no longer take it for granted that the long-term treasury are convenient. Due to the balance sheet reason and also due to the international comparison and due to the cyclicality with respect to the stock markets. And very quickly, just to look at the international comparison first, and then we'll go back to the balance sheet stuff later, is you might be familiar with recent work by Lustig, Krishnamurthy, and Jiang, where they look at the convenience yield difference between government bonds, where they focus on like a 1 year maturity. So they were taking a 1 year difference in the swapped German bond yield with the 1 year US Treasury yield. So here I'm plotting you 3 months difference. Very similar story compared to that line of work in the sense prior to the global financial crisis, despite that the CIP for LIBOR was 0, right? The CIP deviation for LIBOR showing green was 0. There was always some CIP deviation for government bond yield in the sense the treasury is convenient, like the US, I mean, global investors are willing to forego some extra yield captured by the magnitude of this orange line holding treasury as opposed to holding some swapped foreign government bonds or holding like a synthetic treasury. Okay, and that was always the case. So treasury continue its convenience yield post-crisis. The convenience yield widened during the peak of crisis, but that phenomena only holds at short maturities. If you go to the long maturity, which is shown on this right, like it's completely different, right? What you have is this LIBOR picture first, which we understood from the previous segment of the lecture. The CIP deviation for LIBOR was close to 0. It increased during the peak of GFC and then stayed high. But for the long-dated treasury bonds, if anything, the US treasury bond has actually lost its specialness. There was a convenience prior to GFC, but not anymore. And if you look at the full term structure here, I'm plotting the more extreme one, which is I'm taking a 10-year tenor as example. But if you look across different tenors, basically around 5 years, you probably are at 0 on average, and then you became negative at 10. So negative means global investors are not actually willing to forego extra yield in holding US Treasury than holding on average synthetic Treasury. If anything, they're demanding more to hold US Treasury than holding an average synthetic G10 country Treasury. So there is certainly a change at the long end, I think, which really casts doubts on this, whether the US long-dated treasuries are the most convenient assets globally. I think that's questionable. And so what is going on? Like, what are some hypotheses that may help us to think about this loss of specialness or the loss of convenience for the longer dated treasuries in particular? So one very, very important fact is there is a huge mismatch in terms of the supply of treasury versus the intermediary capacity. So that's illustrated by this chart here. So what we have is the marketable treasury debt outstanding, which is like close to $23 trillion today compared to like below $5 trillion prior to the GFC. But if you look at the total intermediaries proxied by the broker-dealer's total assets, if anything, that was growing at a faster rate compared to the treasury market supply. but sort of plateaued at the peak of GFC and then like came down and then stayed pretty flat, like stagnant, right? So there's this huge gap in terms of the supply of treasuries versus sort of the total assets of, or think about the intermediary capacity of the financial intermediaries. So this is like a big structural problem. I think one needs always to take into account in evaluating like what is going on with the treasury markets. So that's in the background. So there is a recent working paper that I literally just put forth with Benay Bear and Wenhao Li on related topics. And there are a couple of very interesting charts I would like to show you. I obviously do not have time to present the whole paper, but I'll show you some interesting charts. This chart is particularly informative for us. So what is this chart showing is it shows us first this puzzle, the negative swap spreads. So I'm plotting the 30-year interest rate swap index to LIBOR minus the treasury yield in green, right? So this, the axes are on the right. So if you put a mental line around 0, so the swap spread was certainly positive, no surprise, prior to the GFC, reaching like even 200 basis points. So it can go up very high, because this is 30 years. Think about the credit risk, think about convenience. Like the 30-year IRS is completely different from 30-year treasury. Okay, so what's very striking is that the post-crisis, again, putting a mental line around 0, it became negative. So that's the negative swap spread puzzle. But what this chart tells us is it is very correlated with the orange line. What is the orange line? The orange line is the CIP deviations, right? I mean, these are completely different markets. One is the within the US Treasury markets, the difference between the swap spread, the interest rate swap and Treasury. The other is this international thing, is essentially the difference between the implied dollar interest rate from the cash markets and from the swap markets. Why are they correlated post-GFC? I think this really sheds lights on the role of intermediary constraints in driving both spreads, right? If you think about the reason they are correlated, it is because, I mean, they are being priced by the same global intermediaries, and the intermediaries have time-varying constraints. I mean, when there are more constraints, the swap spread and CIP deviation became both more negative, and that's essentially what you have here. In addition, there is another dimension in this chart is we have a quantity here. So the green and the orange are prices. What is the red? The red is quantity. This is the primary dealer's net position in the treasury market. So this is a very important quantity because again, if you think about this as a proxy for the shadow cost on balance sheets, right? The reason that they're now adding a lot of treasuries onto their balance sheet is that pushes the constraint to bind further. So what you see here is that the quantity is pretty much the mirror image of price. So when the inventory or the net position in the treasury market becomes higher for the primary dealers, this happens to be the time that the shadow cost on the constraint is higher, and that happens to be the time that the CIP deviation, the swap spreads are more negative. Okay, so that's how it all fits together. So I think this chart really highlights the role of intermediary constraint, and also in addition to bringing price evidence in terms of co-movements between two seemingly separate arbitrage spreads, there's also quantity evidence that in times when the balance sheet is like more crammed, their dealers put on more balance sheets in terms of their treasury holdings. That's also the time when the balance sheet constraint is tighter and the shadow cost is higher. Okay.
We have one question if you think it's a good time to jump in. Eng, do you want to ask your question?
Sure, I'll precise this as well. So no, it's just, I guess now that I've looked at this chart, it makes a lot of sense that the explanation is intermediary based. Now I just had like one other possible explanation kind of. I mean, I don't know. I was just thinking like there was this whole trend of like global savings glut before, like in the 1990s and like start of the 2000s, right? So you might think that the marginal holder kind of those bonds, of those long-term US assets is not the same before and after because they reduced their exposure. It's not. Yeah, so I don't know. And maybe also that lack of demand just like pushes intermediaries to have to hold more inventory, right? Just makes those markets more illiquid. So I don't know, like if maybe that's also part of the story.
Yeah, very good. A very good discussion here. I do think so far I've been taking a very intermediary centric view, but you're absolutely right. What you are describing is the real money demands might be changing, right? And I do think real money demands is a very important part of the story. So overall, there is overall supply, say that's exogenous determined by fiscal policy. And there is a real money demand that doesn't depend on dealers' balance sheet, right? Because that doesn't need to be financed. So there is no use of FX swap or repo in financing real money demand, say from China's sovereign wealth fund or from Japanese pension funds. And these real demands will be an important way to alleviate the intermediary constraint. So if anything, going back to this chart is whatever the real money demands on average may not have kept pace with this increasing supply. So that might be one reason to explain this overall sort of secular decline in specialness in conjunction with the balance sheet constraint. I will actually have some hypothesis for the role of real money demands when we talk about the implication of the slope of the yield curve later.
There's one more question, Petra.
Yeah, I was just curious to see whether you have a sense or whether it is possible to quantify and compare how much these banks that are able to access international funding markets, how much more money, more arbitrage profits they made post GFC, whether we have a sense of this quantification before and after GFC. Basically, in different words, did the value of this market power increase substantially after the GFC?
Right. Yeah, good question. So it's always a little hard to get the quantity straight. Like in the paper on the money market funds that I referenced, I did some back of envelope calculation on a narrowly defined set of wholesale funding instruments. Like I'm only taking like the very strictly defined like CD, CP, Eurodollar, Fed funds, add them together, which is all unsecured. I think I'm able to uncover about $1.3 trillion of unsecured funding that is sourced or funded at a rate below the CIP threshold rate. So that certainly is an underestimate, but if you like to multiply that by the average CIP, about say 20 basis points, like 20 basis points times like $1.3 trillion is the dollar amount of profits that you can think about, but that's obviously an understatement. Yeah.
And is most of this money made on these kind of end of quarters?
Not so much, yeah. So there's always a bit of a disappointment. Even having worked at the Fed, having access to the best data possible in the U.S., we just do not have very good data on the FX derivatives because of Dodd-Frank has like a strange exemption, so that the DTCC, which is this global trade repository, doesn't deliver data to the U.S. regulators. So me personally have not looked at data myself, but through collaboration with ECB economists working on an ongoing paper, we do see that the quarter end activities do not contract much. So there is a contraction in the net position, like the net lendings, but the overall markets actually did not contract. So what's going on? Like we talk about these quarter end spikes due to balance sheet constraints, like why wouldn't the swap market also contract? It's because there is a big contraction in the cash market. Like it's the on-balance sheet activity that has to contract. And therefore, a lot of residual players that cannot fund in the cash markets have to go to the swap market as an alternative source of funding. So therefore, I believe that is our hypothesis because of this migration. It may not be like the swap markets on quarter end days, even with these crazy spikes, the market is actually functioning. It's just the rates are significantly higher. So yeah, going back to your original question, if you look at the day-to-day arbitrage capital doesn't fluctuate that much for the FX swap. Yeah.
Mm-hmm. Thank you.
Okay. All right, good, very good. So that was very interesting charts, right? And at least we convinced one participant about the intermediary constraint-based stories for the swap spreads. I do think just like sort of personally, this is a big part of the drivers for the negative swap spreads. And there is also, so far we're talking about the dealer's position, right? This is the dealer's own inventory. What's a bit strange about this chart is if you actually go through the, sorry, I have to apologize. Maybe I was misleading you reading the axis on the right.
Yeah, it's the left.
It's actually on the left.
Yeah.
I apologize. And this is obviously labeled as the primary dealer's holding on quantity. So correct that. So what's a bit strange about this chart is that these numbers, even though they are highly correlated with prices, they are super small, right? And we're talking about plus minus like 200 billion. And what are the numbers here? It's like a $22 trillion market. I mean, we all know the recent work by Ralph and Xavier Gabex on this market inelastic hypothesis, right? I mean, it could be like small flows have big price impacts, but maybe this is just a symptom, right? Maybe there's also some other stuff going on that is also correlated with the dealer balance sheets, and they overall play a very important roles. So I do want to highlight, as I discussed, right, there, like as a dealer, if we have an exogenous supply of treasuries and we have some, for now, outside model, like real money demand, so you subtract off those demand, then you are left with a pocket of, just a pool of treasury that has to be financed. So there are two ways to do it. One is as a primary dealers, you are required by law to show up at treasury auctions, right? You have to bid up those treasuries. That's your duty as a primary dealers. So you take those treasuries, but your job, you're a dealer, your job is to go very small in terms of net position. So you have to offload those treasuries. If the real money do not want the treasuries, you do have an alternative, is you can actually offload them to the levered investors, like these relative value hedge funds, who might be interested in collecting the negative swap spreads, or actually more relevantly for them is there is a version that's very similar called Treasury Cash Future basis. So the RV, the relative value hedge funds, may also be interested in taking up those treasury supply, especially when the intermediation spreads are quite high. And what's the problem with that, right? Then they take the treasury, you don't have to take it as the dealer. The problem is that you have to finance those people. The RV hedge funds are actually relying on your balance sheets for repo financing, and therefore the overall usage of the balance sheet still stays constant, despite the fact that you're able to push the treasury holdings from your own balance sheets to the RV hedge funds balance sheets. Maybe by some SEC regulation, because the dealers also have additional risk-weighted capital requirements, having a lower balance sheets in cash treasury is more preferred than like having like a lot of like a higher cash treasury and lower amount repo. So maybe there is some decision to be made there, but overall, I'm saying by being able to push that treasury holdings to RV hedge funds is not going to solve this fundamental problem of this treasury left out by the real money guys needs to use dealer balance sheet to finance. And in the data, we do see a strong co-movement between dealers' own positions with some implied versions of the RV hedge funds positions, which is not reported by public data, obviously, but there is a clue. So if you look at the CFTC websites, and they do publish the treasury futures positions by three types of investors. So those are the dealers, the levered investors, and the asset managers. That's the CFTC's categories. So if you take my earlier slide intuition, right? I mean, how do you know the RV hedge funds cash position in treasury? That should be the flip image of their futures position if they're doing the cash future arbitrage. And that's how this chart is constructed. So I'm overlaying the dealer's cash position with the short position in the treasury futures for the levered investors. And you see very high co-movement. If anything, during the 2017 to 2019 rate hiking and quantity tightening cycle, what we had is both dealers and RV hedge fund increased their treasury holdings tremendously. And that was more than enough to offset the runoff in the Fed balance sheets. Okay, so so overall, yeah, so this is to showing you that dealers' position may just be also a part of these overall activities, and the overall number by adding some implied relative value hedge fund positions can become larger compared to dealer's own position. But both lines, in my views, are going to be needing dealer balance sheets. So that would push the intermediation spreads, both in terms of negative swap spreads and also the treasury cash future basis to go higher in absolute values. Okay, so what we did in this paper is, as you can see, we have CIP and we have OIS. So if we take the term structure of OIS as the monetary policy expectation, so if you think about derivatives or off balance sheet, OIS is like a clean interest rate instrument because the underlying Fed funds rate has very little credit risk. So if you take that as a balance sheet cost-free version of interest rate expectations from monetary policy, if you take our CIP, the entire term structure of CIP as the shadow cost of balance sheet, you can do a pretty good job fitting the actual treasury yield. So what we see here is there are two yields. There is not just one yield. Why there are two yields? Because depending on whether dealers are long or short treasuries, the yield would be different, right? If dealers are long treasuries, they're going long treasury, they're shorting interest rate swaps, the swap spread has to be positive. And if they're shorting treasury, swap spread has to be negative, and they're shorting treasury, they're collecting actually the difference between swap and treasury, and therefore the swap spread has to be positive. So interestingly, if you fit a term structure model and you derive two rates, one is the rates when dealer is long and the other rates is the dealer is short, you see that the actual long-term treasury yield, at least post-crisis, are very, very close to the long rates, consistent with dealers switched from being net shorter to a net long investor in treasuries. And pre-crisis, if anything, it's a little hard to see, but the orange line and the red line tend to move more close to each other. So pre-crisis, the actual treasury yield was actually closer to the curve when dealers was short. So it's not that deep. I mean, what we're saying is like post-crisis, if you look at this, right, dealers are long treasuries, and therefore the swap spread has to be in the right sign for them to collect the spread as opposed to paying the spread. And we think dealers are always in the business of collecting spread because especially post-crisis, by putting on a treasury position is going to be costly for their balance sheet. Treasury yield has to be higher than the swap spread and the swap in order to compensate for this additional balance sheet cost of holding treasury, right? And that only works if they're long. If they're short, it has to go the opposite side again to compensate them for having that balance sheet implications for treasuries. Okay, we are surprisingly running out of time. I guess I should not be surprised myself. It's good. I have one last substantive slide and then we are concluding. So going back to the role of real money demands. If anything, I think maybe we can learn something from this chart. So in addition to this very striking chart I showed you that paints a different, like a very closely related relationship between quantity and price, we have the same price, which is we have the same quantity, which is the primary dealer's positions, also quite correlated in a negative way with the slope of the yield curve. So what is going on, and this relationship post-crisis is like a beautiful scatter on the right. So when the yield curve is very, very steep, the primary dealer's treasury position is low. That is counterintuitive if you don't take an intermediary perspective. Why? Because we think a steeper slope corresponds to higher expected return on holding long-term treasury, right? That's the usual Campbell-Shiller stuff, the expectation hypothesis. And if you think the dealers, I mean, they're in the positions of collecting or earning positive excess returns, then precisely when the slope is high, they should actually be increasing their position as opposed to decreasing their position. It only makes sense if you think about when the slope is high, the real money demand is a function of the slope. So when the long dated treasury is trading, say, at 4% and the 3 months bill is at 1%, the slope is 3%, real money find it very attractive to hold treasuries, and therefore the residual stuff left to dealer becomes lower, and the dealers are willing to hold that and are willing to accept a lower intermediation fee in holding that because they don't have to hold it much. And maybe a more relevant story for today and also for the 2017-2019 rate cycle is that during a rate cycle, quantitative tightening, the yield curves tend to be inverted or very flat. And that's the time when the real money demand is very low or lukewarm. And as a result, dealers and levered investors have to increase their treasury holdings, as we saw in the quantity pictures. And this is the time when the intermediation spreads are higher because their position increases, the shadow cost becomes higher. So that's it. I think we're at 1 more minute for the lecture. Apologies for not being able to have like a more general Q&A, but I think we covered a lot of grounds. So what we learned today is the textbook risk-free arbitrages persisted post-GFC, largely in part due to intermediate balance sheet constraints. And what makes these arbitrages interesting is not just they're like 20 basis points or so, is they're intrinsically linked to monetary policy implementation, transmission, global financial stability. And I hope after sitting through this lecture for this whole morning, like we now appreciate like understanding the plumbing behind the global financial market is of first order importance. And I'll just end up here. Thank you so much for your participation.
Thank you very much, Wenxin. This was great. We are out of time, so we need to wrap up. But I will see you all back tomorrow. We have Honolulu, so look forward to that. Thanks again, Wenxin.
All
Have
right,
a great
thank
rest of
you.
your day.
Bye.
Bye.